Yeah, banks are perhaps the most money to lend defaulter bank size them. Gradually, banks expanded their lending activity to finance houses and commercial real estate. Holding the building as collateral emergency of the information technology has presented a special problem to this traditional form of finance. If the idea does not pan out, the firm may go bankrupt, but there is a no collateral, there is a little of value that the creditor can seize. Introduction, bank and institution, non-bank financial companies, Reserve Bank of India, base rate, nationalize and development of bank, financial sector reform, banking sector reform, new rule or opening bank, the capital and non-residence Indian deposit. There is a first we can see introduction. This sense.
The sense in which we today use the term.
The sense in which we today use the term banking has its origin in the Western world to which India was introduced by the British rulers
Way back in the 17th century. Since then, enough water has flown and today Indian banks are considered among the best banks in the developing world and its attempts to emerge among the best in the world is going on as the Union Budget August 2007 said. A financial institution which accepts different forms of deposits and lends them to the prospective borrowers as well as allows the depositors to withdraw their money from the accounts by check is a bank. If the financial institution has all the same functions but does not allow depositors to issue check and withdraw their money from deposits, then it is a non-bank institution. Non-banking financial companies, NBFCs, a non-banking financial company, NBEF, is a company one registered under the Companies Act, 1956 and is engaged in the business of loans and advances, acquisition of shares, stock, bonds, debentures, securities issued by government or local authority or other securities of like marketable nature, leasing, hire purchase, insurance business, chip business, but does not include any institution whose principal business is that of agriculture activity, industrial activity, sale, purchase, construction of immovable property. A non-banking institution which is a company and which has its principal business of receiving deposits under any scheme or arrangement or any other manner, or lending in any manner is also a non-banking financial company, residuary non-banking company i.e. NBC. NBFCs are doing functions akin to that of banks. However, there are a few differences. NBEF cannot accept demand deposits, which are payable on demand, like the savings and current accounts. 2. It is not a part of the payment and settlement system and as such cannot issue checks to its customers. And 3. Deposit insurance facility is not available for NBEF depositors unlike in case of banks. It means the public deposits with them are unsecured. In case a NBEF defaults in repayment of deposit, the depositor can approach company law board or consumer forum or file a civil suit to recover the deposits. Under the RBI Act, 1934, the NBFCs have to get registered with RBI. However, to obviate dual regulation, certain category of NBFCs which are regulated by other regulators are exempted from the requirement of registration with RBI such as WIST, TR Introduction.
Reserve Bank of India, Venture Capital Fund, Merchant
WTN,
WKWN NGP in NIINGS, Net Stock Broking Companies register with SEBI. 2. Insurance company holding a valid certificate of registration issued by IRDA. 3. Nidri companies under the Companies Act, 1956. 4. Chit companies under the Chit Funds Act, 1982. We. Housing finance companies regulated by National Housing Bank of the RBI. A company incorporated under the Companies Act, 1956 and desirous of commencing business of the NBEF should have a minimum net owned fund, NOF, of 25 rupees lakh, raised to 2 rupees crore from 21st April 1999. NBFCs registered with RBI have been reclassified, since 2006, as the Asset Finance Company, AFC, Investment Company, IC, and the Loan Company, LC. Provisions for accepting deposits are: times there is ceiling on acceptance of public deposits and MEF maintaining required NOF and CRA and complying with the prudential norms can accept public deposits maximum up to 4 times of NOF. Times can offer the maximum 11% rate of interest. Times minimum investment grade credit rating, MIGR, is essential, may get itself rated by any of the 4 rating agencies namely, CRISIL, CARE, ICRA and Fitch Ratings India PVT Limited. Times are allowed to accept renew public deposits for a minimum period of 12 months and maximum period of 60 months, and times effective from April 2004, cannot accept deposits from NRIs except deposits by debit to NRO account of NRIs provided such amount do not represent inward remittance or transfer from NREFCNR account. However, the existing NRI deposits can be renewed. Note: different foreign currency accounts opened by the Indian banks have been given as the last subtopic of this chapter. There is no ceiling on raising of deposits by RNBCs, but every RNBC has to ensure that the amounts deposited and investments made by the company are not less than the aggregate amount of liabilities to the depositors. To secure the interest of depositors, such companies are required to invest in a portfolio comprising of highly liquid and secured instruments with central state government securities, fixed deposit of scheduled commercial banks, SCB, certificate of deposits of SCBFIs, units of mutual funds, etc. The amount payable by way of interest, premium, bonus or other advantage, by whatever name called by them in respect of deposits received shall not be less than the amount calculated at the rate of 5%, to be compounded annually, on the amount deposited in lump sum or at monthly or longer intervals, and at the rate of 3.5%, to be compounded annually, on the amount deposited under daily deposit scheme. Further, an RNBC can accept deposits for a minimum period of 12 months and maximum period of 84 months from the date of receipt of such deposit. Like the NBFCs, they cannot accept deposits repayable on demand. It means they, too, cannot open saving and current accounts.
The Reserve
Bank of India, RBI, was SVIST, UWPWW in .E1SY9E3N5 Jin, Inc.H RBI Act, 1934, as a private bank with 2 extra functions, regulation and control of the banks in India and being the banker of the government. After nationalization in 1949, it emerged as the central banking body of India and it did not remain a bank in the technical sense. Since then, the governments have been handing over different functions to the RBI, which stand today as given below. I. It is the issuing agency of the currency and coins other than rupee 1 currency and coin, which are issued by the Ministry of Finance itself with the signature of the Revenue Secretary on the note. 2. Distributing agent for the currency and coins issued by the government. 3. Banker of the government. 4. Bank of the banks, bank of the last resort. We. Announces the credit and monetary policy for the economy. 6. Stabilizing the rate of inflation. 7. Stabilizing the exchange rate of rupee. 8. Keeper of the foreign currency reserves. 9. Agent of the Government of India in the IMF. Smiley performing a variety of developmental and promotional functions under which it did set up institutions like IDBI, SIDBI, NABD, NHB, etc. Credit and monetary policy. The policy by which the desired level of money flow and its demand is regulated is known as the credit and monetary policy. All over the world it is announced by the central banking body of the country, as the RBI announces it in India. In India there has been a tradition of announcing it twice in a financial year, before the starting of the busy and the slack seasons. But in the reform period, this tradition has been broken. Now the RBI keeps modifying this as per the requirement of the economy, though the practice of the two policy announcements a year still continues. In India, a debate regarding autonomy to the RBI regarding announcement of the policy started when the Narsingham Committee recommended on these lines. As the Governor RBI, it was Bimal Jalan who vocally supported the idea. No such move came from the governments officially, but it is believed that the RBI has been given almost working autonomy in this area. In most of the developed economies, the central bank functions with autonomous powers in this area, bifurcation of politics from the economics. Though we lack such kind of officially open autonomy for the RBI, we have learned enough by now and are better off today. There are many tools by which the RBI regulates the desired required kind of the credit and monetary policy, CRR, SLR, bank rate, repo rate, reverse repo rate, PLR, EXIM interest rate, small savings schemes interest rates, SSSs, interest changes for the instruments of the money market, etc. CRR, the cash reserve ratio, CRR, is the ratio, fixed by the RBI, of the total deposits of a bank in India which is kept with the RBI in cash form. This was fixed to be in TVHIE cent, RWO NWG. EAOSYF N3 Jin TRE 1 NG 5. NAP T a cent. 3A.
Recent
Amendment
2007
has removed BT is HT, W3WWP.EEARSYCENGN it NEF L RO INOG.R Nathan provided a free hand to the RBI in fixing the CRR. At present it is 4.75% and a 1% change in it today affects the economy with 64,000 crore for. An increase sucks this amount from the economy while a decrease injects this amount into the economy. Following the recommendations of the Narsingham Committee on the Financial System, 1991, the government started two major changes concerning the CRR. Reducing the CRR was set as the medium-term objective and it was reduced gradually from its peak of 15% in 1992 to 4.5% by June 2035. After the RBI Amendment Act has been enacted in June 2006, the RBI can now prescribe CRR for scheduled banks without any floor or ceiling rate, thereby removing the statutory minimum CRR limit of 3%. 2. Payment of interest by the RBI on the CRR money to the scheduled banks started in financial year 1999-2000, in the wake of banking slowdown. Though the RBI discontinued interest payments from mid-2007.7 SLR, the statutory liquidity ratio, SLR, is the ratio, fixed by the RBI, of the total deposits of a bank which is to be maintained by the bank with itself in non-cash form prescribed by the government to be in the range of 25 to 40%. At present it is 25%, done in October 1997 after CFS suggestions. 9. It used to be as high as 38.5%. The CFS has recommended the government not to use this money by handing G-Secs to the banks. In its place the market-based interest on it should be paid by the government, it was being advised. However, there has been no follow-up in this regard by the governments. The Government of India has removed the 25% floor for the SLR by an amendment, 2007, providing the RBI a free hand in fixing it. Bank rate, the interest rate which the RBI charges on its long-term lendings is known as the bank rate. The clients who borrow through this route are the GOI, state governments, banks, financial institutions, cooperative banks, NBFCs, etc. The rate has direct impact on the long-term lending activities of the concerned lending bodies operating in the Indian financial system. The rate was realigned 10 with the MSF, Marginal Standing Facility, by the RBI in February 2012. Repo rate, the rate of interest the RBI charges from its clients on their short-term borrowing, is the repo rate in India, which is at present 8% 11 basically. This is abbreviated form of the rate of repurchase, and in Western economies it is known as the rate of discount. 12 In practice it is not called an interest rate but considered a discount on the dated government WIST, TR.
Securities
Which are deposited by the we in ISTI, TIV2 WTWI.ON ACTEONGB in OERR in OGW net for the short term. When they get their securities released from the RBI, the value of the securities is lost by the amount of the current repo rate. This rate functions as the benchmark rate for the interbank short-term market, i.e. call money market, in India. Banks usually use this route for one-day borrowing to fulfill their short-term liquidity crunch. Higher the repo rate, costlier the loans banks forward, and vice versa. It has direct impact on the nominal interest rates of the bank's lending. The repo rate was introduced in December 1992. Reverse repo rate, it is the rate of interest the RBI pays to its clients who offer short-term loan to it. It is reverse of the repo rate, and this was started in November 1996 as part of Liquidity Adjustment Facility, LAF, by the RBI. In practice, financial institutions operating in India park their surplus funds with the RBI for short-term period and earn money. It has a direct bearing on the interest rates charged by the banks and the financial institutions on their different forms of loans. This tool was utilized by the RBI in the wake of over money supply with the Indian banks and lower loan disbursal to serve twin purposes of cutting down banks' losses and the prevailing interest rate 13. It has emerged as a very important tool in direction of following cheap interest regime, the general policy of the RBI since reform process started. Marginal Standing Facility, MSF. 14 MSF is a new scheme announced by the RBI in its monetary policy, 2011-12, which came into effect from 9 May 2011. Under this scheme, banks can borrow overnight up to 1% of their net demand and time liabilities, NDTL, from the RBI, at the interest rate 1%, 100 basis points, higher than the current repo rate. The MSF would be the last resort for banks once they exhaust all borrowing options, including the Liquidity Adjustment Facility, by pledging through government securities, which has lower rate, i.e. repo rate, of interest in comparison with the MSF. The MSF would be a penal rate for banks, and the banks can borrow funds by pledging government securities within the limits of the statutory liquidity ratio. The scheme has been introduced by RBI with the main aim of reducing volatility in the overnight lending rates in the interbank market and to enable smooth monetary transmission in the financial system. Banks can borrow through MSF on all working days except Saturdays, between 3:30 and 4:30 p.m. in Mumbai, where RBI has its headquarters. The minimum amount which can be accessed through MSF is Rs 1 crore and in multiples of Rs 1 crore. MSF represents the upper band of the interest corridor and reverse repo, 7.25%, as the lower band and the repo rate in the middle. To balance the liquidity, RBI would use the sole independent policy rate, which is the repo rate, and the MSF rate automatically adjusts to 1% above the repo rate. Similar to India's MSF, the ECB, European Central Bank, also offers standing facilities called Marginal Lending Facilities, MLF, and the Federal Reserve, the US Central Bank, has discount window systems, DWS. Like the MSF, the Secondary Credit Facility YISMT, a WDVW.EAVSYA in LG Ibn Ring G.Y net, the Federal
Base rate
reserved to the depository institution
in 6 U
sentence WAWW is .ETYSYPANC via NLLE Reno G.V night credit on a very short term basis at rates above the primary credit rate. The effectiveness of standing facilities in reducing volatility have been examined by many scholars, and certain studies have pointed out that in the Federal Reserve System in the United States, the design of the facility decreases a bank's incentive to participate actively in interbank market, i.e. India's coal money market, due to the perceived stigma from using such facility. This in turn reduces the effectiveness of standing facility in reducing interest rate volatility. Bank rates realigned with MSF. The RBI on 15 February 2012 increased the bank rate by 350 basis points from 6% to 9.50% and realigned the bank rate with marginal standing facility, MSF, rate, which, in turn, is linked to the policy repo rate 15. Henceforth, whenever there is an adjustment of the MSF rate, the RBI will consider and align the bank rate with the revised MSF rate. Being the discount rate, the bank rate should technically be higher than the policy repo rate. The bank rate has, however, been kept unchanged at 6% since April 2003. This was mainly for the reason that monetary policy signaling was done through modulations in the reverse repo rate and the repo rate till 3 May 2011, and the policy repo rate under the revised operating procedure of monetary policy from 3 May 2011 onwards. Moreover, under the revised operating procedure, MSF, instituted at 100 basis points above the policy repo rate, has been in operation, which more or less served the purpose of the bank rate. At present, the repo rate is 8.50%, reserve repo 7.50% and MSF 9.50%. Repo rate is the rate at which banks borrow funds from the RBI, and reverse repo rate is the rate at which banks park their funds with the RBI. Under the MSF, banks are permitted to avail themselves of funds from the RBI on overnight basis. The bank rate acts as the penal rate charged on banks for shortfalls in meeting their reserve requirements, CRR and SLR. The bank rate is also used by several financial institutions as a reference rate for indexation purposes. Base rate is the interest rate below which scheduled commercial banks, SCBs, will lend no loans to its customers. It means it is like prime lending rate, PLR, and the benchmark prime lending rate, BPLR, of the past, and is basically a floor rate of interest. It replaced the existing idea of BPLR on 1 July 2010. The BPLR system, while the existing system was of PLR, introduced in 2003, fell short of its original objective of bringing transparency to lending rates. This was mainly because under this system, banks could lend below BPLR. This made a bargaining by the borrower with bank, ultimately one borrower getting cheaper loan than the other, and blurred the attempts of bringing in transparency in the lending business. For the same reason, it was also difficult to assess the transmission of policy rates, i.e. repo rate, reverse repo rate, bank rate, of the Reserve Bank to lending rates of banks. The
Base rate system is aimed at
enhancing weakest RWNSWP.EARSYENNC and ring L.ENN adding rates of banks and enabling better assessment of transmission of monetary policy. To look into this matter, the RBI constituted a working group on benchmark prime lending rate, Chair Deepak Mohanty, to review the present benchmark prime lending rate, BPLR, system and suggest changes to make credit pricing more transparent. Report submitted in October 2009, and accordingly the idea of base rate was implemented. Now, all categories of loans are priced with reference to the base rate only, except the A. Differential rate of interest, DRI, loans, B. Loans to banks' own employees, and C. Loans to banks' depositors against their own deposits. Since the base rate will be the minimum rate for all loans, banks are not permitted to resort to any lending below this rate. Accordingly, the provision of lending below the BPLR to a customer by banks if the loan amount is not less than 2 rupees lakh has been withdrawn. It is expected that the above deregulation of lending rate will increase the credit flow to small borrowers at reasonable rate, and direct bank finance will provide effective competition to other forms of high-cost credit. For export credit, RBI announces the floor rate separately. Banks are required to review the base rate at least once in a quarter and publish the same for the general public. Current credit and monetary policy as per the annual monetary policy statement 2013-14 of the RBI, announced on 3rd May 2013. The key rates of the credit and monetary policy stands as given below. 8.25% saving deposits rate 4.0%, relates to 5 major banks. Term deposits rate 7.5% to 9.00% as the headline inflation rate of India is presently 15th April 2013 at a 3-year low of 5.96%. In December 2009, it was at 4.95%. The business and industry in the country is hopeful of cuts in the CRR as well as the repo rate by the RBI when the central bank announces its annual policy statement, end May 2013. Experts together with the major bankers of the country also believe this action imminent from the RBI as the slackening growth rate of the economy needs some boosting from the interest rate side. 1. Policy rates. Bank rate 8.25%, repo rate 7.25%, reverse repo rate 6.25%, marginal standing facility rate 2. Reserve ratios. Cash reserve ratio 4%, statutory liquidity ratio 23%. 3. Lendnug deposit rates. Base rate 9.70% to 10.25%. The development of banking industry in India has been intertwined with the story of its nationalization. Once the Reserve Bank of India, RBI, was nationalized in 1949 and a central banking was in place, the government considered the nationalizing of selected private banks in the country due to the following major reasons. As the banks were owned and managed by the private sector, the services of the banking were having a narrow reach. The masses had no access to the banking service. 2. The government needed to direct the resources in such a way that greater public benefit could take place. 3. The planned development of the economy required a certain degree of government control on the capital generated by the economy. Nationalization of banks in India took place in the following 2 stages. 1. Emergence of the SBI. The Government of India, with the enactment of the SBI Act, 1955 partially nationalized the 3 imperial banks, mainly operating in the 3 presidencies of past with their 466 branches, and named them the State Bank of India. The first public sector bank emerged in India. The RBI had purchased 92% of the shares in this partial nationalization. Satisfied with the experiment, the government in a related move partially nationalized 8 more private banks, with good regional presence, via SBI Associates Act 1959 and named them as the Associates of the SBI. The RBI had acquired 92% stake in them as well. After merging the State Bank of Bikaner and the State Bank of Jaipur as well, the RBI came up with the State Bank of Bikaner and Jaipur. Now the SBI Group has a total number of 6 banks, SBI being one and 5 of its associates. 2. Emergence of nationalized banks. After the successful experimentation in the partial nationalizations, the government decided to go for complete nationalization. With the help of the Banking Nationalization Act, 1969, the government nationalized a total number of 20 private banks. 14 banks with deposits more than 50 crore nationalized in July 1969, and 2. 6 banks with deposits more than 200 crore nationalized in April 1980. After the merger of the loss-making New Bank of India with the Punjab National Bank, PNB, in September 1993, the total number of the nationalized banks came down to 19. Today, there are 27 public sector banks in India, out of which 19 are nationalized, though none of the so-called nationalized banks have 100% ownership of the Government of India. After the nationalization of banks, the government stopped opening of banks in the private sector, though some foreign private banks were allowed to operate in the country to provide the external currency loans. After India ushered in the era of the economic reforms, the government started a vast nationalization and development of banking. Comprehensive Banking System Reform in with SHT, 8W as LY1N9G9 into E Re9NG3.N.et. Further expansion of banking industry in the country, pre-related developments allowed the I. In 1993 the SBI was allowed access to the capital market with permission given to sell its share to the tune of 33% through SBI Amendment Act 1993. At present, the Government of India has 59.73% shares in the SBI. It was on 9th July 2007 that the entire equity stake of RBI was taken over by the Government of India. Thus, the RBI is no more the holding bank of the SBI and its associates. On 10th October 2007, the government announced its proposal of selling the shares of the SBI and cutting down its stake in it to 53% level so that the bank can go for capitalization. 2. In 1994, the government allowed the nationalized banks to have the access to the capital market with a ceiling of 33% sale of shares through the Banking Companies Amendment Act 1994. Since then, many nationalized banks have tapped the capital market for their capital enhancement, Indian Overseas Bank being the first in the row. Though such banks could be better called the public sector banks, as the GOI holds more than 50% stake in them, they are still known as the nationalized banks. 3. In 1994 itself, the government allowed the opening of private banks in the country. The first private bank of the reform era was the UTI Bank. Since then, a few dozens Indian and foreign private banks have been opened in the country. Thus, since 1993-94 onwards, we see a reversal of the policies governing banks in the country. As a general principle, the public sector and the nationalized banks are to be converted into private sector entities. What would be the minimum government holding in them is still a matter of debate and yet to be decided. 17. The policy of bank consolidation is still being followed by the government, so that these banks could broaden their capital base and emerge as significant players in the global banking competition. 18. Every delay in it will hamper their interests, as per the experts. 3. Emergence of the RRBs. The regional rural banks, RRBs, were first set up on 2nd October 1975. Only 5 in numbers, with the aim to take banking services to the doorsteps of the rural masses, especially in the remote areas with no access to banking services, with twin duties to fulfill: I. To provide credit to the weaker sections of the society at concessional rate of interest who previously depended on private money lending, and 2. To mobilize rural savings and channelize them for supporting productive activities in the rural areas. Following the suggestions of the Kelkar Committee, the government stopped opening new RRBs in 1987. By that time their total number stood at 196. Due to excessive leanings towards social banking and catering to the highly economically weaker sections, these banks started incurring huge losses by early 1980s. For restructuring and strengthening of the banks, the government set up 2 committees, the Bhandari Committee, 1994-95, and the Basu Committee, 1995-96. Out of the total, 171 were running in losses in 1998-99 when the government took some serious decisions.
Financial sector reforms.
I. The obligation of concessional interest rates on its lendings. We lo isati, nwswawb.eo as lysnhg indira ngd.net KRRBs started charging commercial, 2. The target clientele, rural masses, weaker sections, was set free now to lend to anybody. After the above given policy changes, the RRBs started coming out of the red losses. The CFS has recommended to get them merged with their managing nationalized or public sector banks and finally make them part of the would-be 3-tier banking structure of India. At present there are 82 RRBs, 46 amalgamated and 36 standalone, functioning in India even though the amalgamation process is going on, India 2013. The process of economic reforms initiated in 1991 had redefined the role of government in the economy. In coming times, the economy will be dependent on the greater private participation for its development. 19 Such a changed view to development required an overhauling in the investment structure of the economy. Now the private sector was going to demand high investable capital out of the financial system. Thus, an emergent need was felt to restructure the whole financial system of India. The 3 decades after nationalization had seen a phenomenal expansion in the geographical coverage and financial spread of the banking system in the country. As certain weaknesses were found to have developed in the system during the late 80s, it was felt that these had to be addressed to enable the financial system to play its role ushering in a more efficient and competitive economy. Accordingly, a high-level committee on financial system, CFS, was set up on 14 August 1991 to examine all aspects relating to structure, organization, function and procedures of the financial system. Based on its recommendations, a comprehensive reform of the banking system was introduced in the fiscal 1992-93.21. The CFS based its recommendations on certain assumptions 22 which are basic to the banking industry. And the suggestions of the committee became logical in light of this assumption. There is no second opinion about it. The assumption says that the resources of the banks come from the general public and are held by the banks in trust, that they are to be deployed for maximum benefit of the depositors. This assumption automatically implied, that even the government had no business to endanger the solvency, health and efficiency of the nationalized banks under the pretext of using banks' resources for economic planning, social banking, poverty alleviation, etc. 2. Besides, the government had no right to get hold of the funds of the banks at low interest rates and use them for financing its consumption expenditure, i.e. revenue and fiscal deficits, and thus defraud the depositors. The recommendations of the CFS, Narsingham Committee were aimed at ensuring a degree of operational flexibility, 2. Internal autonomy for public sector banks, PSBs, in their decision-making process, and 3. Greater degree of professionalism in banking operation. Wist, Tr.
Recommendation of CFS
Wist, Tr. The CFS recommendation 23 could be summed up under 5 subtitles. 1. On directed investment. The RBI was advised not to use the CRR as a principal instrument of monetary and credit control. In place it should rely on open market operations, OMOs, increasingly. 2. Proposals advised regarding the CRR. CRR should be progressively reduced from the present high level of 15% to 3 to 5%, and 2. RBI should pay interest on the CRR of banks above the basic minimum at a rate of interest equal to the level of banks' 1-year deposit. Concerning the SLR, it was advised to cut it to the minimum level, i.e. 25%, from the present high level of 38.5% in the next 5 years. It was cut down to 25% in October 1997. The government was also suggested to progressively move towards market-based borrowing programs so that banks get economic benefits on their SLR investments. These suggestions were directed to the goal of making more funds available to the banks, converting idle cash for use, and cutting down the interest rates banks charge on their loans. 2. On directed credit program. Under this subtitle, the suggestions revolved around the compulsion of priority sector lending, PSL, by the banks. Directed credit program should be phased out gradually. As per the committee, agriculture and small-scale industries, SSIs, had already grown to a mature stage and they did not require any special support. 2 decades of interest subsidy were enough. Therefore, concessional rates of interest could be dispensed with. 2. Directed credit should not be a regular program, it should be a case of extraordinary support to certain weak sections. Besides, it should be temporary, not a permanent one. 3. Concept of PSL should be redefined to include only the weakest sections of the rural communities such as marginal farmers, rural artisans, village and cottage industries, tiny sector, etc. 4. The redefined PSL should have 10% fixed of the aggregate bank credit. The composition of the PSL should be reviewed after every 3 years. 3. On the structure of interest rates. The major recommendations on the structure of interest rates are: interest rates to be broadly determined by market forces. 2. All controls of interest rates on deposits and lending to be withdrawn. 3. Concessional rates of interest for PSL of small sizes to be phased out and subsidies on the IRDP loans to be withdrawn, with TR. 4. Bank rate to be the anchor rate and all other interest rates to be closely linked to it, and the RBI to be the sole authority to simplify the structure of interest rates. 4. On structural reorganization of the bank. For the structural reorganization of banks, some major suggestions were given. I. Substantial reduction in the number of the PSBs through mergers and acquisitions, to bring about greater efficiency in banking operations. 2. Dual control of RBI and banking division of the Ministry of Finance should go immediately, and RBI to be made the primary agency for the regulation of the banking system. 3. The PSBs to be made free and autonomous. 4. The RBI to examine all the guidelines and directions issued to the banking system in the context of the independence and autonomy of the banks. Every PSB to go for a radical change in work technology and culture, so as to become competitive internally and to be at par with the wide range of innovations taking place abroad. And 6. Finally, the appointment of the Chief Executive of Bank, CMD, was suggested not to be on political considerations but on professionalism and integrity. An independent panel of experts was suggested which should recommend and finalize the suitable candidates for this post. 5. Asset Reconstruction Companies Fund, to tackle the menace of the higher non-performing assets, NPAs, of the banks and the financial institutions. The committee suggested setting up of the Asset Reconstruction Companies Funds, taking clue from the US experience. The committee directly blamed the Government of India, GOI, and the Ministry of Finance for the sad state of affairs of the PSBs. These banks were used and abused by the GOI, the officials, the bank employees and the trade unions. The report adds. The recommendations were revolutionary in many respects and were opposed by the bank unions and the leftist political parties. There were some other major suggestions of the committee which made it possible to get the following 24 things done by the government. I. Opening of new private sector banks permitted in 1993. 2. Prudential norms relating to income recognition, asset classification and provisioning by banks on the basis of objective criteria laid down by the RBI. 3. The introduction of the capital adequacy norms, i.e. CAR provisions, with international standards started. 4. Simplification in the banking regulation, i.e. via a board for financial supervision in 1994, etc. Banking sector reform. New rules for opening banks. The government commenced a comprehensive STI. www.efasyremngpinreorcng.sn is at in the financial system in 1992-93 after the recommendations of the CFS in 1991. In December 1997 the government did set up another committee on the banking sector reform under the chairmanship of M. Narsingham. 25 The objective of the committee is objectively clear by the terms of reference it was given while setting up, to review the progress of banking sector reforms to date and chart a program of financial sector reforms necessary to strengthen India's financial system and make it internationally competitive. The Narsingham Committee 2, popularly called by the Government of India, handed over its reports in April 1998 which included the following major suggestions. 26. I. Need for a stronger banking system for which mergers of the PSBs and the financial institutions, AIFIs, were suggested. Stronger banks and the DFIs, development financial institutions i.e. AIFIs, to be merged while weaker and unviable ones to be closed. 2. A three-tier banking structure was suggested after mergers, times Tier 1 to have 2 to 3 banks of international orientation, times Tier 2 to have 8 to 10 banks of national orientation, and times Tier 3 to have a large number of local banks. The first and second tiers were to take care of the banking needs of the corporate sector in the economy. 3. Higher norms of capital to risk, weighted adequacy ratio, CRA, suggested, increased to 10%. 4. Budgetary recapitalization of the PSBs is not viable and should be abandoned. Legal framework of loan recovery should be strengthened. The government passed the SARFAESI Act 2002. 6. Net NPAs for all banks suggested to be cut down to below 5% by 2000 and 3% by 2002. 7. Rationalization of branches and staffs of the PSBs suggested. 8. Licensing to new private banks, domestic as well as foreign, was suggested to continue with. 9. Banks boards should be depoliticized under RBI supervision. KIST Smiley Board for Financial Regulation and Supervisions, BFRS, should be set up for the whole banking, financial and the NBFCs in India. 27. The Reserve Bank of India announced the much-awaited new eligibility criteria for opening new banks in India by the private entities in September 2011 and finalized in February 2013, after considering advices and suggestions from K business and industry. The issue of giving licenses to a few private parties to start commercial banks has always been a sensitive one. More so, at this juncture, when it is believed that the new policy relaxation is primarily for the benefit of large industrial houses and business groups. Before 1969, many leading banks, including Bank of India, Bank of Baroda via STN open mouth laughing smiley www.eitatsevydn jin oim erim ang.nrectil bank, were owned or controlled by leading business groups. In a two-stage process that began in 1969, the government nationalized these banks in a decision that had as much to do with domestic politics as economics. The case for the takeover was built on the ground that these banks were serving their private promoters' interests and that in any case there was a need to reorient the banking system towards national interests. A period of social control of banks preceded their takeover. The bias against large industrial houses has continued in the reform era. Following the guidelines of 1993 and 2001, some private banks came into being, but none of them was sponsored by large business houses. However, this time it is likely that a few industrial houses will make the grade. The rules are as given below: eligible promoters, entities groups in the private sector, owned and controlled by residents, with diversified ownership, sound credentials and integrity and having successful track record of at least 10 years will be eligible to promote banks. In a significant move, the RBI has barred groups having even an exposure of 10%, by way of assets or income or both, in real estate and or broking activities over the past 3 years. Evidently, these sectors are speculative in nature and the business model adopted in such businesses will be misaligned with that required by a bank. Corporate structure: new banks will be set only through a wholly owned non-operative holding company, NOC, which will be registered with the RBI as a non-banking finance company. All financial activities of the promoter group will come under the NOC. The idea is to ring-fence the financial interests of the group from its other business activities and give a measure of protection to the bank's depositors. Capital requirement: it will be 500 rupees crore. The NOC will hold a minimum 40% of the capital for 5 years from the date of licensing, and aggregate non-resident shareholding will not exceed 49% for the first 5 years. Corporate governance: 50% of the directors of the NOC should be independent directors. Business model: should be realistic and viable and should address how the bank proposes to achieve financial inclusion. Bank should have a fourth of its branches in unbanked rural areas. The RBI will have the powers to vet the business plan and pull up the promoters for any deviations. Amendment to the Banking Regulation Act, 1949, will be carried out to give the central bank extensive powers in a wide range of matters necessary for effective supervision. Listing on stock exchanges: the bank shall get its shares listed on the stock exchanges within 2 years of licensing. DRI: the differential rate of interest, DRI, is a lending program launched by the government in April 1972 which makes it obligatory upon all the public sector banks in India to lend 1% of the total lending of the preceding year to the poorest among the poor, at an interest rate of 4% per annum. The total lending in 200506 was 351 crores. Priority sector lending. All Indian banks have to follow the compulsory target of priority sector lending, PSL. The priority sector in India are at present the sector versus is T. WRGRV.ECOSLYTUNRG in Isrim Anga.NLay Lieutenant and Medium Enterprises, SMEs, Road and Water Transport, Retail Trade, Small Business, Small Housing Loans, not more than 10 rupees lakhs, Software Industries, Self-Help Groups, SHGs, Agro-Processing, Small and Marginal Farmers, Artisans, Distressed Urban Poor and Indebted Non-Institutional Debtors besides the SCs, STs and other weaker sections of society. 28 The 5 minorities, namely the Muslims, Christians, Sikhs, Buddhists and Parsis have been included under the PSL. 29 The PSL target must be met by the banks operating in India in the following way. Indian banks need to lend 40% to the priority sector every year, public sector as well as private sector banks, both, of their total lending. There is a sub-target also. 18% of the total lending must go to agriculture and 10% of the total lending or 25% of the priority sector lending, whichever be higher, must be lent out to the weaker sections. Other areas of the priority sector to be covered in the left amount, i.e. 12% of the total lending. 2. Foreign banks have to fulfill only 32% PSL target, which has sub-targets for the exports, 12%, and small and medium enterprises, 10%. It means they need to disburse other areas of the PSL from the remaining 10% of their total lending, lesser burden. The Committee on Financial System, CFS, 1991, had suggested to immediately cut it down to 10% for all banks and completely phasing out of this policy for the betterment of the banking industry in particular and the economy in general. The committee also suggested to shuffle the sectors covered under PSL every 3 years. No follow-up has been done from the government except cutting down PSL target for the foreign banks from 40% to 32%. Meanwhile, some new areas have been added to the PSL. Revision in PSL. The Reserve Bank of India, RBI, panel on priority sector lending on 21 February 2012 proposed that the target, priority sector, for foreign banks to be increased to 40% of net bank credit from the current level of 32% with sub-targets of 15% for exports and 15% for the medium and small enterprises, MSE, sector, within which 7% may be earmarked for micro-enterprises. The target of domestic scheduled commercial banks for lending to the priority sector to be retained at 40% of net bank credit. The Nair Committee, under the chairmanship of M.V. Nair, Chairman, Union Bank of India, has re-examined the existing classification and suggested revised guidelines with regard to priority sector lending and related issues. Major suggestions by the committee are as given below. The committee suggested that the sector, agriculture and allied activities may be a composite sector within the priority sector, by doing away with the distinction between direct and indirect agriculture. However, the targets for agriculture and allied activities would be at 18%. 2. A sub-target for small and marginal farmers within agriculture and allied activities is recommended, equivalent to 9%, which would be achieved in stages by 2015 to 16. 3. The MSE sector may continue to be under the priority sector. Within the MSE sector, a sub-target for micro-enterprises is recommended, equivalent to 7%, which would also be achieved in stages by 2013 to 14. Waste, TR. 4. The loans to housing sector may continue to be under the priority sector. Loans for construction or purchase of one dwelling unit per individual up to 25 rupees lakh, loans up to 2 rupees lakh in rural and semi-urban areas and up to 5 rupees lakh in other centers for repair of damaged dwelling units may be granted under the priority sector. We, to encourage construction of dwelling units for economically weaker sections and low-income groups. Housing loans granted to these individuals may be included in the weaker sections category. 6. All loans to women under the priority sector may also be counted under loans to weaker sections. 7. The loans to education sector may continue to be under the priority sector. The limit under the priority sector for loans for studies in India may be increased to 15 rupees lakh and 25 rupees lakh in case of studies abroad, from the existing limit of 10 rupees lakh and 20 rupees lakh, respectively. 8. The committee has also recommended allowing non-tradable priority sector lending certificates on a pilot basis with domestic scheduled commercial banks, foreign banks and regional rural banks as market players. The menace of NPAs, non-performing assets, NPAs, are bad debts of banks, financial institutions defined as follows: WEF March 31, 2001, 30 an advance of banks FIs where I. Interest and or installment or principal remains overdue for a period more than 180 days in respect of a term loan. 2. Interest and or installment or principal remains overdue for 2 harvest seasons but for a period not exceeding 2.5 years in the case of agricultural loans. The NPAs were classified into 3 types: A. Substandard, remaining NPAs for less than or equal to 18 months, B. Doubtful, remaining NPAs for more than 18 months, and C. Loss assets, where the loss has been identified by the bank or internal external auditors or the RBI inspection but the amount has not been written off. As per the All Indian Bank Employees Association, IBA, the premier union representing bank workers in India, the menace of NPAs has reached the following levels by March 31, 2001. 31 times the NPAs of borrowers account owing more than 1 crore each to banks FIs added to 80,574 crores times if interests are also calculated it becomes over 1,50,000 crores. Times nearly 80% of it is owed to the PSBs, public sector banks. New steps to check NPAs. As per the Economic Survey 2012-13 we ist, HWOFG.HECYN and NGIIN IRIB NGA.N NECTIS remained well capitalized. Concerns regarding growing NPAs persisted. The present situation of the NPAs of the Indian banks is
given below. Times overall NPAs of the banking sector increased from 2.36% of total credit advance in March 2011 to 3.57% of total credit advance in September 2012. While there has been an across-the-board increase in NPAs, the increase has been particularly sharp for the industry and infrastructure sectors, with NPAs as a percentage of credit advance increasing from 1.91% in March 2011 to 3.44% as in September 2012. Sectors particularly under stress include textiles, chemicals, iron and steel, food processing, construction, and telecommunications. Times as per RBI data, gross NPAs, GNPAs of PSBs, public sector banks, have shown a rising trend during the last 3 years from 59,972 rupees crore, March 2010, to 1,44,437 rupees crore, September 2012. As a percentage of credit advanced, NPAs, I.E net NPAs, were at a level of 4.01% in September 2012 compared to 2.09% in September 2008. The main reasons for increase in NPAs of banks are I switchover to system-based identification of NPAs by PSBs. 2. Current macroeconomic situation in the country. 3. Increased interest rates in the recent past. 4. Lower economic growth and weak aggressive lending by banks in the past, especially during good times. Some recent initiatives taken by the government to address the rising NPAs include the appointment of nodal officers in banks for recovery at their head offices, zonal offices for each debts recovery tribunal, DRT. B. Thrust on recovery of lost assets by banks. C. Close watch on NPAs by picking up early warning signals and ensuring timely corrective steps by banks. D. Directing the state-level bankers committee to be proactive in resolving issues with the state governments. And E. Designating asset reconstruction companies, ARCs, resolution agents of banks. The RBI has also announced the following remedial measures: a restructured standard account provisioning raised from the existing 2% to 2.75%. B. The sanction of fresh loans, ad hoc loans from 1st January 2013 will be made on the basis of sharing of information among banks. C. Banks will conduct sector activity-wise analysis of NPAs. D. Banks will put in place a robust mechanism for early detection of sign of distress, amendments in recovery laws, and strengthening of credit appraisal and post-credit monitoring. SARFAESI Act 2002 Wist, TR. Capital adequacy
ratio GOI finally cracked down on the willful VDIESTF. WLWT.ER as SYBNY Jin PAS in SGI.NAGT. The securitization and reconstruction of financial assets and enforcement of security interest, SARFAESI, Act 2002. The Act gives far-reaching powers to the bank's FIs concerning NPAs. One bank's FIs having 75% of the dues owed by the borrower can collectively proceed on the following in the event of the account becoming NPA. A. Issue notice of default to borrowers asking to clear dues within 60 days. B. On the borrower's failure to repay, I. Take possession of security and or 2. Take over the management of the borrowing concern and or 3. Appoint a person to manage the concern. C. If the case is already before the BIF, the proceedings can be stalled if banks' FIs having 75% share in the dues have taken any steps to recover the dues under the provisions of the ordinance. 2. The bank's FIs can also sell the security to a securitization or asset reconstruction company, ARC, Est. Under the provisions of the ordinance, the ARC is sought to be set up on the lines similar to the USA.
Few years
ago. Debt recovery tribunals, DRTs. Earlier, the government had set up debt recovery tribunals, DRTs, in 1993, which failed to bring about the desired change in the scenario due to 32I. DRTs are also clogged up with many cases and the judgment takes time, many months, if not years. 2. The sale of property can be made only through court-appointed officials, adding delays. 3. The tribunals cannot take up the medium or large-sized firms if they are under consideration of the BIF due to sickness. The praiseworthy step regarding recovery of the NPAs and allowing the setting up of the asset reconstruction companies, ARCs, had an impact. Improved industrial climate and new options available to banks for dealing with bad loans helped in recovering a substantial amount of NPAs. The NPAs of scheduled commercial banks, SCBs, were at 2.3% of total assets at end December 2011.33. At first sight, bank is a business or industry, a segment of the service sector in any economy. But the failure of a bank may have far greater damaging impact on an economy than any other kind of business or commercial activity. Basically, modern economies are heavily dependent on banks today than in the past. Banks are today called the backbone of economies. Healthy functioning of banks is today essential for the proper functioning of an economy. As credit creation, i.e. loan disbursals, of banks are highly risky business, the depositor's money depends on the bank's quality of lending. More. Importantly, the whole payment system, VPIU STB, LW IVQA.E SUSWA YNLGL INA ESRIN PGR.NI Tate, depends on banks. A bank's failure has the potential of creating chaos in an economy. This is why governments of the world pay special attention to the regulatory aspects of the banks. Every regulatory provision for banks tries to achieve a simple equation, i.e., How the banks should maximize their credit creation by minimizing the risk and continue functioning permanently. In the banking business, risks are always there and cannot be made zero, as any loan forwarded to any individual or firm, irrespective of their creditworthiness, has the risk of turning out to be a bad debt, i.e. NPA in India, the probability of this being 50%. But banks must function so that economies can function. Finally, the central banks of the world started devising tools to minimize the risks of banking at one hand and providing cushions, shock absorbers, to the banks at the other hand so that banks do not go bust, i.e. shut down after becoming bankrupt. Providing cushion shock absorbers to banks has seen three major developments. 34i. The provision of keeping a cash ratio of total deposits mobilized by the banks, known as the CRR in India. 2. The provision of maintaining some assets of the deposits mobilized by the banks with the banks themselves in non-cash form, known as the SLR in India. And 3. The provision of the Capital Adequacy Ratio, CAR, norm. The Capital Adequacy Ratio, CAR, norm has been the last provision to emerge in the area of regulating the banks in such a way that they can sustain the probable risks and uncertainties of lending. It was in 1988 that the central banking bodies of the developed economies agreed upon such a provision, the CAR, also known as the Basel Accord 35. The accord was agreed upon at Basel, Switzerland at a meeting of the Bank for International Settlements, BIS. 36. It was at this time that the Basel norms of the capital adequacy ratio were agreed upon. A requirement was imposed upon the banks to maintain a certain amount of free capital, i.e. ratio, to their assets. 37. i.e. loans and investments by the banks, as a cushion against probable losses in investments and loans. In 1988, this ratio capital was decided to be 8%. It means that if the total investments and loans forwarded by a bank amounts to 100, the bank needs to maintain a free capital 38 of 8 at that particular time. The capital adequacy ratio is the percentage of total capital to the total risk-weighted assets. See reference 39. Capital adequacy ratio, CAR, a measure of a bank's capital, is expressed as a percentage of a bank's risk-weighted credit exposures. CAR is equal to total of the Tier 1 and Tier 2 capitals divided by risk-weighted assets, also known as capital to risk-weighted assets ratio, CRA. This ratio is used to protect depositors and promote the stability and efficiency of financial systems around the world. Two types of capital were measured as per the Basel II norms: Tier 1 capital, which can absorb losses without a bank being required to cease trading, and Tier 2 capital, which can absorb losses in the event of a winding up and so provides a lesser degree of protection to depositors. The new norms, Basel III, has devised a third category of capital: Tier 3 capital. The RBI introduced the capital to risk-weighted assets ratio, CRA, system for the banks operating in India in 1992 in accordance with the standards of the BIS. As part of the financial sector reforms. 39 In the coming years, the Basel norms were extended to term lending institutions, primary dealers and non-banking financial companies, NBFCs, too. Meanwhile, the BIS came up with another
Why to maintain CAR?
set of the CAR norms, popularly known as ST, BWW Ausay.LSI.YIE.NGT ING area NGB.NA IT guidelines regarding the CAR norms in India have been as given below. 1. Basel I norm of the CAR was to be achieved by the Indian banks by March 1997. 2. The CAR norm was raised to 9% with effect from 31st March 2000. Narsingham Committee 2 had recommended to raise it to 10% in 1998. 43. Foreign banks as well as Indian banks with foreign presence to follow Basel II norms with 31st March 2008, while other scheduled commercial banks to follow it not later than 31st March 2009. The Basel II norm for the CAR is 12%. 41. The basic question which comes to mind is as to why do the banks need to hold capital in the form of CAR norms? Two reasons. 42 have been generally forwarded for the same. Bank capital helps to prevent bank failure, which arises in case the bank cannot satisfy its obligations to pay the depositors and other creditors. The low capital bank has a negative net worth after the loss in its business. In other words, it turns into insolvent capital, therefore, acts as a cushion to lessen the chance of the bank turning insolvent. 2. The amount of capital affects returns for the owners, equity holders, of the bank. Basel Accords. The Basel Accords, i.e. Basel I, II and now Basel III, are a set of agreements set by the Basel Committee on Bank Supervision, BCBS, which provides recommendations on banking regulations in regards to capital risk, market risk and operational risk. The purpose of the accords is to ensure that financial institutions have enough capital on account to meet obligations and absorb unexpected losses. They are of paramount importance to the banking world and are presently implemented by over 100 countries across the world. The BIS Accords were the outcome of a long drawn-out initiative to strive for greater international uniformity in prudential capital standards for banks' credit risk. The objectives of the Accords could be summed up 43 as I. To strengthen the international banking system, 2. To promote convergence of national capital standards, and 3. To iron out competitive inequalities among banks across countries of the world. The Basel Capital Adequacy Risk-Related Ratio Agreement of 1988, i.e. Basel I, was not a legal document. It was designed to apply to internationally active banks of member countries of the Basel Committee on Banking Supervision, BCBS, of the BIS at Basel, Switzerland. But the details of its implementation were left to national discretion. This is why Basel I looked G10-centric. 44 The first Basel Accord, known as Basel I, was issued in 1988 and focuses on the capital adequacy of financial institutions. The capital adequacy risk, the risk a financial institution faces due to an unexpected loss, categorized the assets of financial institution into 5 risk categories: 0%, 10%, 20%, 50%, 100%. Banks that operate internationally are required to have a risk weight of 8% or less. WIST, the second Basel Accord, known as Basel II, is to be fully implemented by 2015. It focuses on 3 main areas, including minimum capital requirements, supervisory review and market discipline, which are known as the 3 pillars. The focus of this accord is to strengthen international banking requirements as well as to supervise and enforce these requirements. The third Basel Accord, known as Basel III, is a comprehensive set of reform measures aimed to strengthen the regulation, supervision and risk management of the banking sector. These measures aim 45 to I. Improve the banking sector's ability to absorb shocks arising from financial and economic stress, whatever the source. 2. Improve risk management and governance. 3. Strengthen banks' transparency and disclosures. The capital of the banks has been classified into 3 tiers as given below. Tier 1 capital, a term used to describe the capital adequacy of a bank. It can absorb losses without a bank being required to cease trading. This is the core measure of a bank's financial strength from a regulator's point of view. This is the most reliable form of capital. It consists of the types of financial capital considered the most reliable and liquid. Primarily stockholders' equity and disclosed reserves of the bank. Equity capital can't be redeemed at the option of the holder, and disclosed reserves are the liquid assets available with the bank itself. Tier 2 capital, a term used to describe the capital adequacy of a bank. It can absorb losses in the event of a winding up and so provides a lesser degree of protection to depositors. Tier 2 capital is secondary bank capital, the second most reliable forms of capital. This is related to Tier 1 capital. This capital is a measure of a bank's financial strength from a regulator's point of view. It consists of accumulated after-tax surplus of retained earnings, revaluation reserves of fixed assets and long-term holdings of equity securities, general loan loss reserves, hybrid, debt equity, capital instruments, and subordinated debt and undisclosed reserves. Tier 3 capital, a term used to describe the capital adequacy of a bank, considered the tertiary capital of the banks, which are used to meet support markets risk, commodities risk and foreign currency risk. It includes a variety of debt other than Tier 1 and Tier 2 capitals. Tier 3 capital debts may include a greater number of subordinated issues, undisclosed reserves and general loss reserves compared to Tier 2 capital. To qualify as Tier 3 capital, assets must be limited to 250% of a bank's Tier 1 capital, be unsecured, subordinated and have a minimum maturity of 2 years. Disclosed reserves are the total liquid cash and the SLR assets and of the banks that may be used any time. This way they are part of its core capital, Tier 1. Undisclosed reserves are the unpublished or hidden reserves of a financial institution that may not appear on publicly available documents such as a balance sheet, but are nonetheless real assets, which are accepted as such by most banking institutions but cannot be used at will of the bank. That is why they are part of its secondary capital, Tier 2. Basel III Provisions 46. The new provisions have defined the capital of the banks in differ VN IST, www.ry.eacfneg inec iorin ngs.nid ter common.
Equity
And retained earnings as the pre-video STM, W in WN.E task UIM and JIPNE ONRIA NGN.N TETUF capital, as the past, but they restrict inclusion of items such as deferred tax assets, mortgage servicing rights and investments in financial institutions to no more than 15% of the common equity component. These rules aim to improve the quantity and quality of the capital. While the key capital ratio has been raised to 7% of risky assets, according to the new norms, Tier I capital that includes common equity and perpetual preferred stock will be raised from 2 to 4.5% starting in phases from January 2013 to be completed by January 2015. In addition, banks will have to set aside another 2.5% as a contingency for future stress. Banks that fail to meet the buffer would be unable to pay dividends, though they will not be forced to raise cash. The new norms are based on renewed focus of central bankers on macroprudential stability. The global financial crisis following the crisis in the US subprime market has prompted this change in approach. The previous set of guidelines, popularly known as Basel II, focused on macroprudential regulation. In other words, global regulators are now focusing on financial stability of the system as a whole rather than micro-regulation of any individual bank. Banks in the West, which are market leaders for the most part, face low growth and erosion in capital due to sovereign debt exposures and stiffer regulation. They will have to reckon with a permanent decline in their returns on equity thanks to enhanced capital requirements under the new norms. In contrast, Indian banks, and those in other emerging markets such as China and Brazil, are well placed to maintain their returns on capital consequent to Basel III. The financial experts have opined that Basel III looks changing the economic landscape in which banking power shifts towards the emerging markets. Preparing PSBs for Basel III capital compliance, as capital is a key measure of banks' capacity for generating loan assets and is essential for balance sheet expansion. The Government of India, GOI, has regularly invested additional capital in the PSBs to support their growth and keep them financially sound so as to ensure that the growing credit needs of the economy are adequately met. A sum of 12,000 rupees crore was infused in 7 PSBs during 2011-12 to enable them to maintain a minimum Tier I CRAR of 8% and also to increase shareholding of the GOI in them. In 2012-13 also, the government has infused capital in PSBs to augment their Tier I capital so that they maintain their Tier I CRAR at a comfortable level and remain compliant with the stricter capital adequacy norms 47 under Basel III. This will also support internationally active PSBs in their national and international banking operations undertaken through their subsidiaries and associates. An amount of 12 rupees 517 crore was allocated by the GOI for the year 2012-13 on 10th January 2013. The High-Level Committee to assist the capitalization of PSBs in the next 10 years, headed by the Finance Secretary, has recommended various options for funding of PSBs given the budgetary constraints. It may not be feasible for the government to infuse huge sums into the PSBs. This is why the committee has recommended the formation of a non-operating financial holding company, Holdco, under a special Act of Parliament with the following key objectives: I. To act as an investment company for the GOI. 2. To hold a major portion of the GOI's holdings in all PSBs, WIST, TR.
3. To raise long-term
Long-term
debt
debt from UBM IST, markets to infuse equity into PSBs, and 4. To service the debt from within its sources. Due to weakening of the RRBs, also their sponsor banks have been incurring huge NPAs. RRBs have played a pivotal role in credit delivery in rural areas, particularly to the agriculture sector, to enhance their outreach and provide banking services more effectively to rural masses. RRBs need to undertake a continuous process of technology and capital upgradation. With a view to bringing the CRAR of RRBs up to at least 9%, Dr. K.C. Chakrabarti Committee recommended recapitalization support to the extent of 2,200 rupees crore to 40 RRBs in 21 states. Pursuant to the recommendation of the committee, recapitalization amount is to be shared by the stakeholders in proportion to their shareholding in RRBs, i.e. 50% central government, 15% concerned state government, and 35% the concerned sponsor banks. The recapitalization will continue up to March 2014. Stock of money in every economy. It is necessary for the central bank to know the stock, amount level, of money available in the economy. Only then it can go for suitable kind of credit and monetary policy. Saying simply, credit and monetary policy of an economy is all about changing the level of money flowing in the economic system. But it can be done only when we know the real flow of money. That's why it is necessary to first assess the level of money flowing in the economy. Following the recommendations of the Second Working Group on Money Supply, SWG, in 1977, RBI has been publishing 4 monetary aggregates. Component of money, M1, M2, M3 and M4, are basically short terms for the money 1, money 2, money 3 and money 4, besides the reserve money. These components used to contain money of differing liquidities. M1 is equal to currency and coins with people plus demand deposits of banks, current and saving accounts, plus other deposits of the RBI. M2 is equal to M1 plus demand deposits of the post offices, i.e. saving schemes money. M3 is equal to M1 plus time term deposits of the banks, i.e. the money lying in the recurring deposits and the fixed deposits. M4 is equal to M3 plus total deposits of the post offices, both demand and term time deposits. Now the RBI has started 48 publishing a set of new monetary aggregates following the recommendations of the Working Group on Money Supply, Analytics and Methodology of Compilation, Chairman, Dr. Y.V. Reddy, which submitted its report in June 1998. The working group recommended compilation of 4 monetary aggregates on the basis of the balance sheet of the banking sector in conformity with the norms of progressive liquidity, M0, monetary base, M1, narrow money, M2 and M3, broad money. In addition to the monetary aggregates, the working group had recommended compilation of 3 liquidity aggregates, namely, L1, L2 and L3, which include select items of financial liabilities of non-depository financial corporations such as development financial institutions and non-banking financial companies accepting deposits from the public, apart from post office savings banks. The new monetary AGVG is RTE, WGWRT.EEs ASIARNE GIANE SR in IGV.NE NT below.
Reserve
Reserve
money,
money,
M0,
is equal to currency in C7 SRTC, WT.IEOASNA plus ANGNBEA ring NGK.NERTS deposits with the RBI plus other 49 deposits with the RBI. Narrow money, M1, is equal to currency with the public plus demand deposits with the banking system plus other deposits with the RBI. M2 is equal to M1 plus savings deposits of post office savings banks. Broad money, M3, is equal to M1 plus time deposits with the banking system. M4 is equal to M3 plus all deposits with post office savings banks, excluding national savings certificates. While the working group did not recommend any change in the definition of reserve money and M1, it proposed a new intermediate monetary aggregate to be referred to as NM2, comprising currency and residents' short-term bank deposits with contractual maturity up to and including 1 year, which would stand in between narrow money, which includes only the non-interest-bearing monetary liabilities of the banking sector, and broad money, an all-encompassing measure that includes long-term time deposits. The new broad money aggregate, referred to as NM3 for the purpose of clarity, in the monetary survey would comprise, in addition to NM2, long-term deposits of residents as well as call-term borrowings from non-bank sources, which have emerged as an important source of resource mobilization for banks. The critical difference between M3 and NM3 is the treatment of non-resident repatriable fixed foreign currency liabilities of the banking system in the money supply compilation. There are two basic changes in the new monetary aggregates. First, since the post office bank is not a part of the banking sector, postal deposits are no longer treated as part of money supply, as was the case in the extant M2 and M4. Second, the residency criterion was adopted to a limited extent for compilation of monetary aggregates. The working group made a recommendation in favor of compilation of monetary aggregates on residency basis. Residency essentially relates to the country in which the holder has a center of economic interest. Holdings of currency and deposits by the non-residents in the rest of the world sector would be determined by their portfolio choice. However, these transactions form part of balance of payments, BOP. Such holdings of currency and deposits are not strictly related to the domestic demand for monetary assets. It is therefore argued that these transactions should be regarded as external liabilities to be netted from foreign currency assets of the banking system. However, in the context of developing countries such as India, which have a large number of expatriate workers who remit their savings in the form of deposits, it could be argued that these non-residents have a center of economic interest in their country of origin. Although in a macroeconomic accounting framework all non-resident deposits need to be separated from domestic deposits and treated as capital flows, the underlying economic reality may point otherwise. In the Indian context, it may not be appropriate to exclude all categories of non-resident deposits from domestic monetary aggregates, as non-resident rupee deposits are essentially integrated into the domestic financial system. The new monetary aggregates, therefore, exclude only non-resident repatriable foreign currency fixed deposits from deposit liabilities and treat those as external liabilities. Accordingly, from among the various categories of non-resident deposits at present, only foreign currency non-resident accounts, banks, FCNR, B, deposits are classified as external liabilities and excluded from the domestic money stock. Since the bulk of the FCNR, B, deposits are
held
held
abroad
abroad
by
by
commercial banks.
the Vism T, OWNBWT.ERASYINJINPEAFNTG.ONFT changes in such deposits is captured through changes in net foreign exchange assets of the commercial banks. Thus, now the new monetary aggregates NM2 and NM3 as well as liquidity aggregates L1, L2 and L3 have been introduced,
The
the components
components
of which are
are
elaborated as follows. NM1 is equal to currency with the public plus demand deposits with the banking system plus other deposits with the RBI. NM2 is equal to NM1 plus short-term time deposits of residents, including and up to the contractual maturity of 1 year. NM3 is equal to NM2 plus long-term time deposits of residents plus call-term funding from financial institutions. L1 is equal to NM3 plus all deposits with the post office savings banks, excluding national savings certificates. L2 is equal to L1 plus term deposits with term lending institutions and refinancing institutions, FIs, plus term borrowing by FIs plus certificates of deposit issued by FIs. L3 is equal to L2 plus public deposits of non-banking financial companies. Data on M0 are published by the RBI on weekly basis, while those for M1 and M3 are available on fortnightly basis. Among liquidity aggregates, data on L1 and L2 are published monthly, while those for L3 are disseminated quarterly. The working group advised for the quarterly publication of financial sector survey to capture the dynamic linkages between banks and rest of the organized financial sector. Liquidity of money as we move from M1 to M4. The liquidity, inertia, stability, spendability of the money goes on decreasing, and in the opposite direction, the liquidity increases. Narrow money in banking terminology, M1 is called narrow money as it is highly liquid and banks cannot run their lending programs with this money. Broad money, the money component M3 is called broad money in the banking terminology. With this money, which lies with banks for a known period, banks run their lending programs. Money supply. In general discussion, we usually use money supply to mean money circulation, money flow in the economy. But in banking and typical monetary management terminology, the level and supply of M3 is known as money supply. The growth rate of broad money, M3, i.e. money supply, was not only lower
than the indicative growth set by the RBST.
but also it witnessed continuous and sequential deceleration in the last 7 quarters and moderated to 11.2% by December 2012. Aggregate deposits with the banks were the major component of broad money, counting for over 85%, remaining almost stable. The sources of broad money are net bank credit to the government and to the commercial sector. These two together accounted for nearly 100% of the broad money in 2012-13 compared to 89% in 2009-10. Minimum reserve. The RBI is required to maintain a reserve equivalent of 200 rupees crores in gold and foreign currency with itself, of which 115 rupees crores should be in gold. This is being followed since 1957 and is known as the minimum reserve system, MISS. Reserve money. The gross amount of the following 6 segments of money at any point of time is known as the reserve money, RM, for the economy or the government. 1. RBI's net credit to the government, 2. RBI's net credit to the banks, 3. RBI's net credit to the commercial banks, 4. Net forex reserve with the RBI, 5. Government's currency liabilities to the public, 6. Net non-monetary liabilities of the RBI. RM is equal to 1 plus 2 plus 3 plus 4 plus 5 plus 6 as per the Economic Survey 2012-13. The rate of growth of reserve money comprising currency in circulation and deposits with RBI, bankers and others, decelerated from an average of 17.6% in Q1 of 2011 to 12 to 4.3% in Q3 of 2012 to 13. Almost the entire increase in the reserve money of Rs 2,381 billion between Q3 of 2011 to 12 and Q3 of 2012 to 13 consisted of increase in currency in circulation. As sources of reserve money, net RBI credit to government and increase in net financial assets of RBI contributed to the growth of base money. Money multiplier at end March 2012, the money multiplier ratio of M3 to M0 was 5.2, higher than end March 2011, due to cumulative 125 basis point reduction in CRR. During 2012 to 13, the money multiplier generally stayed high, reflecting again the CRR cuts. As on 28 December 2012, the money multiplier was 5.5 compared with 5.2 on the corresponding date of the previous year. Economic Survey 2012-13. Credit Council ING advising borrowers to overcome their debt burden and improve money management skills is credit counseling. The first well-known such agency was created in the USA when credit grantors created National Foundation for Credit Counseling, NFCC, in 1951.50.
India's
Sovereign
sovereign
debt is usually rated B. Vivists. If XWMW.EH so is go inventory area Nagi.ing 18 credit rating agencies, SCRAs, of the world which are I. Fitch Ratings, 2. Moody's Investors Service, 3. Standard & Poor's, S&P, 4. Dominion Bond Rating Service, DBRS, we Japanese Credit
Rating Agency, JCRA, and 6. Rating and Investment Information Incorporated, Tokyo, R&I. As on 15 January 2013, most of these rating agencies have put India under stable category in foreign and local currencies, barring Fitch and S&P, which have put its foreign currency in negative category. The government is taking a number of steps to improve its interaction with the major SCRAs so that they make informed decisions, as the Economic Survey 2012-13 says. Credit rating to assess the creditworthiness, credit record, integrity, capability of a prospective would-be borrower to meet debt obligations is credit rating. Today it is done in the cases of individuals, companies and even countries. There are some world-renowned agencies such as the Moody's, S&P. The concept was first introduced by John Moody in the USA, 1909. Usually equity share is not rated here. Primarily, ratings are an investor service. Credit rating was introduced in India in 1988 by the ICICI and UTI, jointly. The major credit rating agencies of India, CRISIL, Credit Rating Information of India Limited, was jointly promoted by ICICI and UTI with share capital coming from SBI, LIC, United India Insurance Company Limited to rate debt instrument, debenture. In April 2005, its 51% equity was acquired by the US credit rating agency Standard & Poor, S&P, a McGraw-Hill group of companies. 2. ICRA, Investment Information and Credit Rating Agency of India Limited, was set up in 1991 by IFCI, LIC, SBI and select banks as well as financial institutions to rate debt instruments. 3. CARE, Credit Analysis and Research Limited, was set up in 1993 by IDBI, other financial institutions, nationalized banks and private sector finance companies to rate all types of debt instruments. 4. ONICRA, Onida Individual Credit Rating Agency of India Limited, was set up by Onida Finance, a private sector finance company, in 1995 to rate creditworthiness of non-corporate consumers and their debt instruments, i.e. credit cards, hire purchase, housing finance, rental agreements and bank finance. SMERA, Small and Medium Enterprises Rating Agency, was set up in September 2005 to rate the overall strength of small and medium enterprises, SMEs, the erstwhile SSIs. It is not a credit rating agency precisely, but its ratings are used for this purpose. 2. A joint venture of SIDBI, the largest shareholder with 22% stake, SBI, ICICI Bank, Dun & Bradstreet, an international credit information company, 5 public sector banks, PNB, BON, BOI, Canara Bank, UBI with 28% stake together, and CIBIL, Credit Information.
Non-Resident Indian Deposits Bureau of India Limited. WIST, TR, a general credit rating service not linked to any debt issue, is also availed by companies, already offered in India by rating agencies. CRISIL calls such ratings as Credit Assessment. 51 International rating agencies such as Moody's, S&P also undertake sovereign ratings, i.e. of countries, highly instrumental in external borrowings of the countries. Individuals are also covered by credit appraisal, which is on useful information for the consumer credit firms. To maintain a database on the credit records of individuals, the Credit Information Bureau of India Limited, CIBIL, was set up in May 2004, which makes credit informations available to banks and financial institutions about prospective individual borrowers. 52 Foreign Exchange Management, Deposit, Regulations, 2000 permits non-resident Indians, NRIs, to have deposit accounts with authorized dealers and with banks authorized by the Reserve Bank of India, RBI, which include 53(1) foreign currency, non-resident, bank, account, FCNR, B, account, 2. Non-resident external account, NRE account, 3. Non-resident ordinary rupee account, NRO account, FCNR, B, accounts can be opened by NRIs and overseas corporate bodies, OCBs, with an authorized dealer. The accounts can be opened in the form of term deposits. Deposits of funds are allowed in pound sterling, US dollar, Japanese yen and euro. Rate of interest applicable to these accounts are in accordance with the directives issued by RBI from time to time. NRE accounts can be opened by NRIs and OCBs with authorized dealers and with banks authorized by RBI. These can be in the form of savings, current, recurring or fixed deposit accounts. Deposits are allowed in any permitted currency. Rate of interest applicable to these accounts are in accordance with the directives issued by RBI from time to time. NRO accounts can be opened by any person resident outside India with an authorized dealer or an authorized bank for collecting their funds from local bona fide transactions in Indian rupees. When a resident becomes an NRI, his existing rupee accounts are designated as NRO. These accounts can be in the form of current, savings, recurring or fixed deposit accounts. There were two more NRI deposit accounts in operation, viz. Non-resident, non-repatriable, rupee deposit account and non-resident, special, rupee account and amendment to foreign exchange management, deposit, regulations, in 2002, discontinued the acceptance of deposits in these two accounts from April 2002 onwards. Repatriation of funds in FCNR, B, and NRE accounts is permitted. Hence, deposits in these accounts are included in India's external debt outstanding. While the principle of NRO deposits is non-repatriable, current income and interest earning is repatriable. Account holders of NRO accounts are permitted to annually remit an amount up to $1 million out of the balances held in their accounts. Therefore, deposits in NRO accounts too are included in India's external debt. Guidelines for licensing of new VB IST WNWKWS.EasyEngineering.net. The RBI on 22 February 2013 released the guidelines for licensing of new banks in the private sector. Key features of the guidelines are 1. Eligible promoters, a private sector, public sector non-banking financial companies, NBFCs, entity group eligible to set up a bank through a wholly owned, non-operative financial holding company, NOFSC. 2. Fit and proper criteria, a past record of sound credentials, integrity and sound financial background with a successful track record of 10 years will be required. 3. Corporate structure of the NOFSC. The NOFSC to be wholly owned by the promoter group which shall hold the bank as well as all the other financial services entities of the group. 4. Minimum voting equity capital requirements for banks and shareholding by NOFSC. The initial minimum paid-up voting equity capital 54 for a bank shall be 5 rupees billion. The NOFSC shall initially hold a minimum of 40% of the paid-up voting equity capital of the bank which shall be locked in for a period of 5 years and which shall be brought down to 15% within 12 years. Banks' shares to be listed on the stock exchanges within 3 years of the business commencement. 5. Regulatory framework. The bank to be regulated by the relevant acts, statutes, directives, issued by RBI and other regulators. The NOFSC shall be registered as a non-banking finance company, NBFC, with the RBI and will be governed by a separate set of directions issued by RBI. 6. Foreign shareholding in the bank. Foreign shareholding up to 49% for the first 5 years, after which it will be as per the extent policy. 7. Corporate governance of NOFSC. At least 50% of the directors of the NOFSC should be independent directors. The corporate structure should not impede effective supervision of the bank and the NOFSC by RBI. 8. Prudential norms for the NOFSC. The prudential norms will be applied to NOFSC on similar lines as that of the bank. 9. Exposure norms. The bank NOFSC allowed no exposure to the promoter group. The bank shall not invest in the equity debt capital instruments of any financial entities held by the NOFSC. 10. Business plan for the bank. The business plan should be realistic and viable and should address how the bank proposes to achieve financial inclusion. 11. Additional conditions for NBFCs promoting converting into a bank. Existing NBFCs, if considered eligible, may be permitted to promote a new bank or convert themselves into banks. 12. Other conditions for the bank. to open at least 25% of its branches in unbanked rural centers, population up to 9,999 as per the latest census. B. To comply with the priority sector lending targets applicable to the existing domestic
Banks.
Waste. TRD banks promoted by groups having 40% or more assets income from non-financial business will require RBI's prior approval for raising paid-up voting equity capital beyond 10 rupees billion. Any non-compliance of terms and conditions will attract penal measures including cancellation of license of the bank. Non-operative financial holding company, NOFC. 55. The difference between an operating company and a holding company lies in the fundamental structures of the two, in their management and their interactions with one another. Business goals are often different, and both business types are after profits, but holding companies can still benefit from operating company losses under certain conditions. The primary function of a holding company is to invest in other companies, commonly known as subsidiaries. Holding companies are usually not involved in day-to-day operations of the operating company, but lend initial or ongoing financial support via cash reserves or stock sales, and may assist in restructuring the operational model to ensure profits. Holding companies are normally structured as corporations, limited liability firms, i.e. known as a limited company in India, to protect assets and absorb financial losses. Operating companies are owned by the holding company, but are responsible for all day-to-day operations of the company. When a holding company creates or purchases an operating company, they are sometimes allowed to conduct business as usual, especially if they are profitable. Net profits after expenses are then handed over to the holding company. Ownership of operating companies, even when purchased, revert to the holding company. Former owners who are kept on board are often given control of the operating company in the form of executive management responsibility, but have no ownership rights. All major decisions that may affect profitability or involve large expenditures must first be approved by the holding company. Although operating company profitability should make sense for the holding company, this is not always the case. Especially for larger holding companies with heavy tax burdens, owning one or more operating companies that lose money can benefit the parent company in the form of a business loss when tax time rolls around. This does not benefit the operating company, as it is responsible for operating income to run the business. If the losses become too great, operating companies can go out of business, but the holding company can still benefit because the operating company can help to balance overall profits and stock prices. There are three basic types of holding companies. A pure holding company that is non-operating and exists solely to invest in and hold the voting shares of its subsidiaries. This type of holding company derives its income from the dividends earned from its ownership of the shares of its subsidiaries and from any gains realized from other investments. 2. A general or operating holding company that earns its income from selling goods and services in addition to the income derived from its ownership of subsidiaries. 3. A pyramid holding company that owns controlling inter-versus is TT. If NWW it dot ESAS ye unbgs in IDEI RIA and RGINEST with less. Invested capital than the 2 ASVA ist. AWTWAUG. OER as ESN. Genering net nidhi in the Indian context. Treasure. However, in the Indian financial sector it refers to any mutual benefit society 56 notified by the Central Union Government as a nidhi company. They are created mainly for cultivating the habit of thrift and savings amongst its members. The companies doing nidhi business, with borrowing from members and lending to members only, are known under different names such as nidhi, permanent fund, benefit funds, mutual benefit funds and mutual benefit company. Nidhis are more popular in South India and are highly localized single office institutions. They are mutual benefit societies, because their dealings are restricted only to the members, and membership is limited to individuals. The principal source of funds is the contribution from the members. The loans are given to the members at relatively reasonable rates for purposes such as house construction or repairs and are generally secured. The deposits mobilized by NIDHIS are not much when compared to the organized banking sector. NIDHIS are companies registered under the Companies Act, 1956 and are regulated by Ministry of Corporate Affairs, MCA. Even though NIDHIS are regulated by the provisions of the Companies Act, 1956, they are exempted from certain provisions of the Act, as applicable to other companies, due to limiting their operations within members. NIDHIS are also included in the definition of non-banking financial companies or NBFCs, which operate mainly in the unorganized money market. However, since 1997, NBFCs have been brought increasingly under the regulatory ambit of the RBI. Non-banking financial entities partially or wholly regulated by the RBI include INBFCs comprising equipment leasing, L, hire purchase finance, HP, loan, LC, investment, IC, including primary dealers, PDS, and residuary non-banking, RNBC, companies. 2. Mutual Benefit Financial Company, BEFC, i.e. NIDHI Company. 3. Mutual Benefit Company, MBC, i.e. Potential NIDHI Company, i.e. a company which is working on the lines of a NIDHI company but has not yet been so declared by the central government, has minimum net owned fund, NOF, of 10 rupees lakh, has applied to the RBI for certificate of registration and also to Department of Company Affairs, DCA, for being notified as NIDHI company and has not contravened directions regulations of RBI DCA. 4. Miscellaneous non-banking company, MNBC, i.e. chit fund company. Since NIDHIS come under one class of NBFCs, RBI is empowered to issue directions to them in matters relating to their deposit acceptance activities. However, in recognition of the fact that these NIDHIS deal with their shareholder members only, RBI has exempted the notified NIDHIS from the core provisions of the RBI Act and other directions applicable to NBFCs. As on date, February 2013, RBI does not have any specified regulatory framework for NIDHIS. The central government in March 2000 constituted a committee to examine the various aspects of the functioning of NIDHI companies. There was no government notification defining the word NIDHI. Taking into consideration the manner of functioning of NIDHIS and the recommendations of the P.
Sabharyagan Committee in its report via STN open mouth laughing smiley WL.SEO ASI to NGIF NADI RIV NGE.NNFT unscrupulous persons using the word NIDHI in their name without being incorporated by Department of Company Affairs, DCA, and yet doing NIDHI business. The committee suggested the following definition for NIDHIS. A part of this definition is appearing in the New Companies Bill 2012, Section 406. NIDHI is a company formed with the exclusive object of cultivating the habit of thrift, savings and functioning for the mutual benefit of members by receiving deposits only from individuals enrolled as members and by lending only to individuals also enrolled as members, and which functions as per notification and guidelines prescribed by the DCA. The word NIDHI shall not form part of the name of any company, firm or individual engaged in borrowing and lending money without incorporation by DCA, and such contravention will attract penal action. Chit Fund. Recently, Chit Fund was in center of news after the Kolkata-based Saradha Chit Fund scam came to light. Most of the media people were themselves not very clear about the finer points related to the idea of chits in India, but they kept on highlighting chits as they needed to report on the scam. Let us try understanding the chits and some other similar concepts in India. Chit funds, also known by their other names such as Chitti, Kuri, miscellaneous non-banking company, are essentially saving institutions. They are of various forms and lack any standardized form. Chit funds have regular members who make periodical subscriptions to the fund. The periodic collection is given to some member of the chit funds selected on the basis of previously agreed criterion. The beneficiary is selected usually on the basis of bids or by draw of lots, or in some cases by auction or by tender. In any case, each member of the chit fund is assured of his turn before the second round starts, and any member becomes entitled to get periodic collection again. Chit funds are the Indian versions of rotating savings and credit associations found across the globe. Chit fund business is regulated under the Central Act of Chit Funds Act 1982 and the rules framed under this act by the various state governments for this purpose. Central government has not framed any rules of operation for them. Thus, registration and regulation of chit funds are carried out by state governments under the rules framed by them. Functionally, chit funds are included in the definition of non-banking financial companies by RBI under the subhead Miscellaneous Non-Banking Company, MNBC. But RBI has not laid out any separate regulatory framework for them. Official definition, as per the Chit Funds Act 1982, chit means a transaction whether called chit, chit fund, chitty, kuri or by any other name by or under which a person enters into an agreement with a specified number of persons that every one of them shall subscribe a certain sum of money, or a certain quantity of grain instead, by way of periodical installments over a definite period, and that each such subscriber shall, in his turn, as determined by lot or by auction or by tender or in such other manner as may be specified in the chit agreement, be entitled to the prize amount. A transaction is not a chit, if in such transaction some alone, but not all, of the subscribers get the prize amount without any liability to pay future subscriptions, or 2. All the subscribers get the chit amount by turns with the liability to pay future subscriptions. Waste, TR1. The discussion here is based on the updated information released by the RBI, 11 May 2012. 2. Based on the RBI Nationalisation Act, 1949 and further announcements of the Government of India, MoF. 3. RBI Act, 1934, subsection 1, of section 42. 4. Annual Policy Statement 201011, RBI, 20th April 2010, Delhi and RBI dated 17 March 2011. 5. Economic Survey, 200607, MoF, GOI, Delhi. 6. RBI, Amendment, Act, 2006, GOI, Delhi. 7. Credit and Monetary Policy, 1st April 2007, OPCIT. 8. RBI Act, 1934 and Banking Regulation Act, 1949 Section 24. 9. Committee on Financial System, CFS, headed by the then RBI Deputy Governor M. Narasimhan, 1991. 10. Through an RBI announcement on 15 February 2012. 11. Pivot 12. Stiglitz and Walsh, Economics, OPCIT, P6 to 9630. 13. Economic Survey 200102, MoF, GOI, Delhi. 14. The write-up is based on the RBI's Credit and Monetary Policy, 2011 to 12, in which the scheme was introduced, and the European Central Bank, Frankfurt, Germany and Federal Reserve System, also known as the Federal Reserve, and informally as the Fed, Washington, D.C., USA 15. RBI Announcement, RBI, MoF, GOI, New Delhi, 15 February 2012. 16. RBI Announcement, RBI, MoF, GOI, New Delhi, 5th April 2010. 17. As per the Strategic Disinvestment Statement of 1999, the government had decided to cut its holding in them to 26%. The policy was put on hold once the UPA government came to power. 18. Y.V. Reddy, Lectures on Economic and Financial Sector Reforms in India, Oxford U. Press, N. Delhi, 2002, pp. 13757. 19. Repeated by the GOI many times, i.e. the New Industrial Policy 1991, the Union Budget 199-93, 8th 5-year Plan, 199-97, Draft Approach, etc. 20. Announced by the government while setting up the M. Narasimhan Committee on Financial System on August 14, 1991. See also India 2001, Pub. Viv, GOI, N. Delhi. 21. The Narasimhan Committee handed over its report in record time within 3 months after it was set up.
22 CFS, OPCIT, 23 IBID, 24 based on Vairi Reddy, 2002, OPCIT, 25 Economic Survey 199899, MOEF, GOI, N. Delhi, 26 based on the report of the Committee on Banking Sector Reforms, April 1998, Chairman, M. Narsingham. 27 An integrated system of regulation and supervision was suggested by the committee so that soundness of the financial system could be ensured. The concept of a financial super-regulator gets vindicated, as opines Y. V. Reddy, 2002, OP cited, p. 28, India 2007, Pub. Leave, GOI, N. Delhi and the further announcements by the RBI. 29 The change was effected from 20th May 2007 as per the RBI announcement. 30 Economic Survey 200102. MOEF, GOI, N. Delhi. 31 IBID. 32 Economic Survey February 2001 and India 2002. Pub. Leave, GOI, N. Delhi. 33 Economic Survey 201112. MOEF, GOI, N. Delhi. 34 Through various legislations since the RBI Nationalization Act, 1949 and the Banking Regulation Act, 1949 were enacted and further amendments to the acts, MOEF, GOI, New Delhi. 35 Simon Cox, ed. Economics, The Economist, 2007, OPCIT, p. 145. 36 The Biz is today a central bank for central bankers set up in 1930 in a round tower near Basel railway station in Switzerland as a private company owned by a number of central banks, one commercial bank, Citibank, and some private individuals. Today it functions as a meeting place for the bank regulators of many countries, a multilateral regulatory authority and a clearing house for many nations' reserves, i.e. foreign exchange. See Tim Hindle, Pocket Finance, The Economist, 2007, pp. 35-36. 37 Investments made and loans forwarded by banks are known as risky assets. The capital of a bank was classified into Tier V2 Sutton. DWTWIWR.E2A.SYWNHGLIE net EIRE in RGI.NCEO team prizes share capital and disclosed reserves. Tier 2 includes revaluation reserves, hybrid capital and subordinated debt of a bank. As per the provision, Tier 2 capital should not exceed the Tier I capital. The risk weighting depends upon the type of assets. For example, it is 100% on private sector loans while only 20% for short-term loans. 39 The RBI is a member of the board of the BIS. The financial sector reforms commenced in India in the fiscal 1992-93 after the report submitted by the Narsingham Committee on Financial System, CFS. 40 Committee on Banking Sector Reforms, M. Narsingham Committee 2, MOEF, GOI, New Delhi, April 1998. 41 Economic Survey 200607, MOEF, GOI, N. Delhi. 42 D.M. Natne, Pathray and Sibold Ghosh, India Development Report 200405, Oxford University Press, N. Delhi, 2005, p. 171. 43 Idea May 2004, OPCIT, p. 172. 44 G-10 comprises Belgium, Canada, France, Germany, Italy, Japan, the Netherlands, Sweden, UK, and USA. Later the group incorporated Luxembourg, Switzerland and recently Spain in its fold. 45 Bank of International Settlements, Basel, Switzerland, 15th May 2012. 46 Reserve Bank of India, MOEF, GOI, New Delhi, 5th May 2012. 47 Basel III norms prescribe a minimum regulatory capital of 10.5% for banks by 1st January 2019. This includes a minimum of 6% Tier I capital, plus a minimum of 2% Tier 2 capital, and a 2.5% capital conservation buffer. For this buffer, banks are expected to set aside profits made during good times so that it can be drawn upon during periods of stress. 48. The working group was set up in December 1997 under the chairmanship of Y. V. Reddy, the then Deputy Governor, RBI, which submitted its report in June 1998. 49. Other deposits with RBI comprise mainly I. Deposits of quasi-government, other financial institutions including primary dealers. 2. Balances in the accounts of foreign central banks and governments, and 3. Accounts of international agencies such as the International Monetary Fund. 50. Y. V. Reddy, the RBI Governor, The Economic Times, N. Delhi, 11th September 2006. 51. S. Sundararajan, Book of Financial Terms, Tata McGraw-Hill, N. Delhi, 2004, p. 44. 52. IBID. 53. As per the latest update by the RBI, 11th May 2012. 54. The part of authorized capital, the limit up to which a company can issue shares, which has been actually paid by the shareholders is known as the paid-up capital of a company. For detailed analysis of different kind of capitals of a company, refer the Chapter 14, Security Market in India. 55. Though this subtopic originally belongs to the Chapter 14, Security Market in India, it has been discussed here to make the new guidelines of setting up banks an easy-to-understand thing for the readers. 56. Mutual Benefit Society, also known globally as Benefit Society or Mutual Aid Society, is an organization or voluntary association formed to provide mutual aid, benefit, or insurance for relief from common difficulties. Such organizations may be formally organized with charters and established customs, or may arise ad hoc to meet unique needs of a particular time and place. They may be organized around a shared ethnic background, religion, occupation, geographical region or other basis. Benefits may include money or assistance for sickness, retirement, education, birth of a baby, funeral and medical expenses, unemployment. Often benefit societies provide a social or educational framework for members and their families to support each other and contribute to the wider community. A benefit society may have some common features: members having equivalent opportunity in the organization, members having equivalent benefits, aid goes to needy, stronger helping the weaker, payment of benefits by collection of funds from the members, educating others about a group's interest, preserving cultural traditions, and mutual defense. Examples of benefit societies include trade unions, self-help groups, etc. It is believed that such societies predate human culture, are found around the world.
Whist.
Whist. TR.
Insurance industry in economic terms,
anything used to cut down the risk is known as insurance. But in familiar terms, insurance is provided by an insurance company which covers a person's life, called life segment, or covers loss of assets, property, called non-life or general segment. The insurance policies are purchased at fixed premiums. LIC, the life insurance business industry in the country, was nationalized by the Government of India in 1956 and a fully government-owned company, the Life Insurance Corporation of India, LIC, was set up. At that time 245 Indian and foreign companies were playing in the life segment of insurance. Opening of private life insurance companies was prohibited at the same that time. The LIC was called an investment institution by the government. The nationalization was motivated by twin objectives: first, to spread the message of life insurance for greater social security, and secondly, to mobilize people's savings, collected as premiums, for nation building. The LIC had been the biggest investor in the government's parks of planned development, purchasing government securities, GSECs, and equities of the big asset public sector undertaking, PSUs. The market share of these insurers was 68.84% and 31.16% respectively in the corresponding period of 2010 to 11, Economic Survey 2012-13. GIC in 1971, the government nationalized the private sector companies, 107 Indian and foreign companies, playing in the general insurance segment, and a government company, the General Insurance Corporation of India, GIC, was formed in 1972. The GIC started operation on 1 January 1973 with its 4 holding companies, 1 National Insurance Company Limited, 2 New India Assurance Company Limited, 3 Oriental Fire and Insurance Company Limited, 4 United India Insurance Company Ltd. In the era of economic reforms, 2 major changes took place in this area. In November 2000, the GIC was notified as the Indian Reinsurer 1, 2. In March 2002, the GIC was withdrawn from holding company status of the 4 public sector general insurance companies. Now these 4 companies are directly owned by the Government of India too. The market shares of the public and private insurers are 57.80 and 42.20% in 2011-12 as WIST, TR definition. Insurance reforms against 59.07 and 40.93 in the previous VYI lista, RW, VWC.eo and SEOIM Andy in CES Rio NGR.we NITY 2010. Under the process of Economic Reforms and Insurance Reforms Committee, IRC, was set up in April 1993 under the chairmanship of the ex-RBI Governor R.N. Malhotra. The committee handed over its report, January 1994, with the following major suggestions. 3. Decontrolling insurance sector, allowing Indian as well as foreign private sector insurance companies to enter the sector. The government did it in 1999, passing the IRDA Act. 2. Restructuring the LIC and the GIC and cutting down the government's holding in them to 50%. No follow-up still, but the private insurance companies demanding it anxiously. The NDA government had taken steps in this area, but the UPA government has no such plans. Late 2012, the government started sale of the LIC shares, but to public sector undertakings, seen as a welcome move. 3. Delinking GIC and its 4 subsidiaries, which was done in 2000. 4. Discarding the system of licensing of surveyors by the Controller of Insurance. Restructuring the Tariff Advisory Committee. 6. Setting up a regulatory authority for the insurance industry, the IRDA, set up in 2000. IRDA, the Insurance Regulatory and Development Authority, IRDA, was set up in 2000. The Act was passed in 1999, with 1 chairman and 5 members, 2 as whole-time and 3 as part-time members, appointed and nominated by the government. The authority is responsible for the regulation, development and supervision of the Indian insurance industry. There are 29 insurance companies in India, 15 in life segment and 14 in the non-life segment, which have been able to cover 40 million lives in the country. Out of the local life and non-life segment, insurance coverage in the rural areas have a share of 17% and 14% respectively. Still too much needs to be done for the development of insurance in the country. See the select model answers on the topic. ACIL, the Agricultural Insurance Company of India Limited, ACIL, was set up in 2002 in the public sector to look after the National Agricultural Insurance Schemes, NAIS, of 19,994. Till its arrival, the responsibility was on the GIC, whose losses were supposed to be reimbursed by the central government. Now the GIC does not play this role. Public sector insurance companies: there are 6 public sector insurance companies operating in the country, 1 in life segment, LIC, 4 in the non-life segment and 1 in the agriculture sector, ACIL, WE.IST, TR.
National Export Insurance Account,
NIA, reinsurance waste, TR. When an insurance company gets insurance coverage on its insurance policies, it is considered a case of reinsurance. For the development of insurance in an economy, the presence of reinsurance companies is a precondition. It becomes an essential precondition if the economy is trying to develop and expand insurance with the active participation of the private sector insurance companies. This made the government convert the GIC into a reinsurance company in 2000. This is the sole reinsurer in India, that too in the public sector. Nobody can be a better insurer or reinsurer than the government itself. Deposit Insurance and Credit Guarantee Corporation, DIC, was set up by merging the Deposit Insurance Corporation, 1962, and the Credit Guarantee Corporation, 1971, in 1978. While deposit insurance had been introduced in India out of concerns to protect depositors, ensure financial stability, instill confidence in the banking system and help mobilize deposits, the establishment of the Credit Guarantee Corporation was essentially in the realm of affirmative action to ensure that the credit needs of the hitherto neglected sectors and weaker sections were met. The essential concern was to persuade banks to make available credit to not so creditworthy clients. After the merger, the focus of the DIC had shifted onto credit guarantees. This owed in part to the fact that most large banks were nationalized. With the financial sector reforms undertaken in the 1990s, credit guarantees have been gradually phased out and the focus of the corporation is veering back to its core function of deposit insurance with the objective of averting panics, reducing systemic risk, and ensuring financial stability. Export Credit Guarantee Corporation, ECGC, the overseas projects undertaken by the Indian companies face many political and commercial risks in the importing countries. To provide adequate credit insurance cover to such firms, the government has set up the Export Credit Guarantee Corporation of India Limited, ECGC, under the Ministry of Commerce and Industry, for medium and long-term exports. But owing to its own limitations, at times it is difficult for ECGC to cover pure commercial risks in issues like long repayment period, the large value of contracts, difficult economic and political conditions of the importing country, together with the fact that reinsurance cover is generally not available for such projects. 5 Many times such projects look necessary considering the economic and political relationship of India with the proposed importing country. It means that in the absence of credit insurance cover, the ability of Indian exporters to go for such export projects is hampered. It should be noted that in many developed economies such projects are covered and underwritten on Government Account 6. For facilitating the service of the ECGC, discussed above, the Government of India did set up the National Export Insurance Account, NEIA, in March 2006 to promote MWWAUD.IEUMSYN AGNA in DE Rio NGN.G Neterm Export.
By providing credit insurance
support in 6 TSHTE. WCOS.ESSYWENHGINRE.NGC.TC was not able to provide credit cover on its own because of purely commercial reasons. 7. The corpus given to the account was 66 crore, raised to 246 crore by 200708 and will be enhanced to 2000 crore in the 11th plan, 200712. 2. Resources of the NEIA will be the corpus, the premium income, interest income and recovery of all the claims paid. 3. As per the provision, an exposure equal to 10 times corpus can be taken by the NEIA. The NEIA can cover projects which fulfill the following criteria. The project by itself should be commercially viable. 2. The project should be strategically important for India, with regard to economic and political relationship of India with the importing country, and 3. The exporter should be capable of executing the contract, as evident from his previous track record. The use and benefits of the NEIA need to be publicized among its beneficiaries. Meanwhile, many export projects pertaining to Indonesia, Vietnam, Iran, Sudan, etc. are underway. The NEIA will facilitate potential project exporters to enter the international trade area, as it is expected to be so. In the era of globalization, it has been praised as a welcome development by the experts and the trade people alike. The challenge ahead since the opening up of the insurance sector, the number of participants in the insurance industry has gone up from 7 insurers, including the Life Insurance Corporation of India, LIC, 4 public sector general insurers, 1 specialized insurer, and the General Insurance Corporation as the national reinsurer, in 2000 to 52 insurers as on 30th September 2012 operating in the life, non-life, and reinsurance segments, including specialized insurers, namely the Export Credit Guarantee Corporation and Agricultural Insurance Company, AIC. 4 of the general insurance companies, viz. Star Health and Alliance Insurance Company, Apollo Munich Health Insurance Company, Max Bupa Health Insurance Company, and Religare Health Insurance Company function as standalone health insurance companies. Of the 23 insurance companies that have set up operations in the life segment post-opening up of the sector, 21 are in joint ventures with foreign partners. Of the 21 private insurers who have commenced operations in the non-life segment, 18 are in collaboration with foreign partners. After the state monopoly in the insurance sector was dismantled and private players' entry allowed, the IRDA has played a crucial role in the development and expansion of the sector. There is no doubt in it. But still the sector faces many challenges which, if only tackled well, may one say that insurance is serving the interests of the insuring companies and the covered alike. As per the concerned experts, the major challenges Indian insurance is facing today may be seen as given below. 1. As per various estimates, only 20% of the insurable Indian population is life insured. The share of India in global life insurance is just 0.66%, and life insurance penetration
is at present 2.5.
2.53%, 2004 2 STN, wfview.eosu.yn at nrgyn.e1e0 ring net. The message of life insurance needs to be publicized among the population, especially in the rural areas. Moreover, social security schemes should be expanded to cover the poor masses who lack the premium paying capacity. 2 experts suggest that health insurance could emerge among the most important factors of improving human development in the country if expanded in a focused way and via an action plan. It is estimated that around 15% of the Indian population is covered under some form of prepayment on healthcare, which includes employees and beneficiaries covered under SS, CGHS, armed forces, central police organizations, railways, employer self-funded schemes, the PSUs and pensions covered under health insurance. 11 The health insurance penetration is at present at 1.536% only, 200506. Besides the LIC, the private players should be promoted to enter the foray, especially in the rural areas. 3 After the general insurance industry was opened up, 2000, for the private sector participation, the experience has been positive 12. Its growth compares favorably with that of many other emerging markets and is in line with global benchmark of 2 to 3 times the growth in GDP. 13. As the economy is on a strong growth path and the capital expenditure planned across industries is estimated to be over 9 lakhs crore over the next 4 to 5 years, a better scope for the general insurance expansion is probable. 14. The growth in both commercial and personal lines of general insurance business reflects positive trends. Over 70% of India's population lives in rural areas, and along with organized financial services, general insurance companies are also expanding into these sectors. 4 People in their lives experience financial difficulties that can affect the entire family negatively. This is more true about the poor masses in India. This is why the experts suggested for the provision of micro-insurance. A relatively new concept, micro-insurance is today provided to the beneficiaries of the microfinance, covering the finance amount, reducing the risk of the clients as well as the microfinance institutions, MFIs. 15. The concept of micro-insurance has been developed by the private insurance company Aviva Life Insurance, in partnership with MFIs, which has forged alliances with banks like Canara Bank, P&SB, RRBs, 23 cooperatives, etc. to promote microfinance. Microinsurance has evolved in the past 2 decades of research in microfinance and has seen growth in countries like Sri Lanka, Philippines in the last decade 16. Here NGOs and people's organizations are allowed to register themselves as micro-insurance companies which sell such insurance. As they cover the risk themselves, they are allowed to reinsure with one of the large global companies like Swiss Re or Munich Re. Same model is suggested for India, but for this to happen drastic changes in the existing insurance rules are required. 17. 5. Many of the experts believe that insurance industry should benefit the insurers, reinsurers as well as the insured. The social purpose of the insurance sector is never praiseworthy to be marginalized by the corporate interests, be domestic or foreign. At least it does never taste good in India, which needs a strong social safety net. 18.6. Almost all of the private insurance companies in India have been demanding that the government-owned insurance companies, ILIC, and the 4 general insurance companies
should be converted into preview via ZTE.
www.caswinc.nneits. Their reasons are logical, as in comparison with the government-owned insurance companies, private companies are always ready with highly attractive and lucrative insurance schemes, but they have not been able to attract the clients for them. Therefore, the private insurance companies have been fetching huge operational losses due to lack of the desired level of their expansion and the overhead expenditure. 19. Insurance penetration. The growth in the insurance sector is internationally measured based on the standard of insurance penetration. Insurance penetration is defined as the ratio of premium underwritten in a given year to the gross domestic product, GDP. Likewise, insurance density is another well-recognized benchmark and is defined as the ratio of premium underwritten in a given year to total population, measured in US dollars for convenience of comparison. The Indian insurance business has in the past remained underdeveloped with low levels of insurance penetration. Post-liberalization 20, the sector has succeeded in raising the levels of insurance penetration from 2.3, life 1.8 and non-life 0.7, in 2000 to 5.1, life 3.4 and non-life 0.7, in 2011. As per the Economic Survey 2012 to 13, despite the growth in the insurance sector that was witnessed during the last few decades, insurance penetration and density remained low as compared to other developing countries of the world. It was felt that various legislative provisions were archaic and needed revision in line with the changing market conditions. Accordingly, the government introduced the Insurance Laws Amendment Bill 2008 in the Rajya Sabha on 22 December 2008. Based on the recommendations of the Standing Committee, the official amendments to the Insurance Laws Amendment Bill 2008 are proposed to be introduced at the earliest. The survey further adds that limited choice and high cost of providing covers, and 2. Assessing claims are some of the issues that need to be suitably addressed to make insurance funds an effective means of channelizing savings to investments. Policy initiatives committed to expand and strengthen the insurance industry in the country, following the recommendations of the Malhotra Committee Report, 1993, the GOI has taken the following policy initiatives. 21 in the recent years. 1. Health insurance. The Insurance Regulatory Development Authority, IRDA, has been taking a number of proactive steps as part of the initiatives for the spread of health insurance. It had set up a National Health Insurance Working Group in 2003, which provided a platform for the various stakeholders in the health insurance industry to work together and suggest solutions on various relevant issues in the sector. The IRDA is also coordinating with and supporting insurance industry initiatives in standardizing certain key terminology used in health insurance documents, for better comprehension and in the interest of policyholders. The General Insurance Council, comprising all non-life insurers, evolved a consensus on a uniform
Definition of
of pre-existing disease say ist WNWD.EISYTSNG9 neg LRUNSGI no 8 and wording, which has earlier been an expression with many definitions, still more interpretations, and certainly a whole lot of grievances.
such
Such standardization, effective 1st June 2008, will help the insured by minimizing ambiguity and also by better comparability of health insurance products. Also, with effect from 1st October 2011, portability in health insurance has been started, in which an insured, if not happy with services or the product of the existing insurer, can change to another insurer whilst enjoying the benefits, especially that of pre-existing diseases, of his existing policy. 2. Micro-insurance. Micro-insurance regulations issued by the IRDA have provided a fillip to propagating micro-insurance as a conceptual issue. With the positive and facilitative approach adopted under the micro-insurance regulations, it is expected that all insurance companies would come out with a progressive business approach and carry forward the spirit of regulations, thereby extending insurance penetration to all segments of society. Presently, there are 10,482 micro-insurance agents operating in the micro-insurance sector. 3. Insurance Laws Amendment, Bill 2008. The bill aimed to amend the Insurance Act 1938, the General Insurance Business Nationalization Act 1972, and the Insurance Regulatory and Development Authority Act 1999. The Standing Committee on Finance has submitted its report to the Parliament on 13 December 2011. The report of the committee is under examination by the government. Amendments to the LIC Act 1956, the LIC Amendment Bill 2011 was passed by Parliament on 12 December 2011. The amendments will enable the LIC to raise its equity capital from 5 rupees crore to 100 rupees crore and create a reserve fund to be used for its business expansion and meeting its corporate social responsibility. 1 India 2002, Pub. Dev, Goi, N. Delhi 2. Economic Survey 200203, MOEF, Goi, N. Delhi. 3 R. N. Malhotra headed Insurance Reforms Committee, Goi, N. Delhi, January 1994. 4 Economic Survey 200203, MOEF, Goi, N. Delhi. 5 Due to its underwriting constraint, the ECGC is unable to cover such projects on its own. 6 As for example the USA, France, the UK and many other Euro-American economies underwrite such medium and long-term projects in the government's account. The SEIA also covers only medium and long-term export projects only. 7 Announced while setting up the NEIA, Ministry of Commerce and Industry, Goi, N. Delhi, 9 March 2006. 8 IBID. 9 S. Pravakaran, Executive Director, ECGC, Mumbai in Survey of Indian Industry 2007, The Hindu, p. 84. 10 S. Krishnamurthy, CEO and MD, SBI Life Insurance Co. Limited Survey of Indian Industry 2007, OPCIT, p. 9111. Alok Gupta, Health Insurance Consultant, Survey of Indian Industry, OPCIT, p. 94. 12 Sandeep Bakshi, CEO and MD, ICICI Lombard General Insurance Company, Mumbai, Survey of Indian Industry 2007, OPCIT, p. 99. 13 IBID. 14 IBID. 15 Vivek Khanna, Director, Aviva India, Survey of Indian Industry 2007, OPCIT, p. 102. 16 IBID. 17 It has been beautifully shown taking example of the Self-Employed Women's Association, SEWA, by Rinana Jabwala and Ravi Kanbar in the Kaushik Basu edited India's Emerging Economy, Oxford Univ. Press, N. Delhi, 2005, pp. 30911.
18 Biplab Das Gupta,
Globalization, India's ADUI SITSMT, ANWT, WX.EPASREAN, ESRA INGGE.NPA Publication, N. Delhi, 2005, pp. 221931. 19 G. V. Rao, CMD, Oriental Insurance Co. Limited, Survey of Indian Industry 2007, The Hindu, pp. 8790. 20 Economic Survey 2012-13, OPCIT, p. 127. 21 Economic Survey 2011-12, OPCIT, pp. 128-129.
Whist. TR. Whist. TR. The segment of a financial market of
an economy from long-term capital is raised via instruments such as shares, securities, bonds, debentures, mutual funds is known as the security market of that economy. A security market has components such as a security regulator, SEBI in India, stock exchanges, different share indices, brokers, FIIs, jobbers, etc. There are different kinds of transactions which take place in a security market such as Badla, reverse Badla, future trading, insider trading, not allowed, private placement, etc. Primary and secondary markets. Every security market has two complementary markets, primary and the secondary. The market in which the instruments of security market are traded, procured, directly between the capital raiser and the instrument purchaser is known as the primary market. As for example, a share being directly purchased by anybody from the issuer, which may be the company itself. The person is known as the primary shareholder. The market where the instruments of security market are traded among the primary instrument holders is known as the secondary market. Such transactions need an institutionalized floor for their trading, which is made available by the stock exchanges. Stock exchange, a physically existing institutionalized setup where instruments of security stock market, shares, bonds, debentures, securities, etc. are traded. It serves the following major functions. I. Makes a floor available to the buyers and sellers of stocks, and liquidity comes to the stocks. It is the single most important institution in the secondary market for securities. 2. Makes available the prices of trading as an important piece of information to the investors. 3. By following institutionalized rules and procedures, it ensures that the participants in the stock market live up to their commitments. 4. Passes updated informations to the enlisted companies about their present stockholders, so that they can pass on dividends etc. to them. By publishing its index, it fulfills the purpose of projecting the moods of the stock market. World's first stock exchange was established in Antwerp, Belgium, then part of the Netherlands, in 1631. The London Stock Exchange opened in 1773, and then Philadelphia Stock Exchange, the first in the New World, opened in 1790. The first stock exchange in India, the Bombay Stock Exchange, known as the Native Share and Stock Brokers Association, was set up in 1870, under a tree. 2. Whist. TR definition.
Top 5 largest stock
exchanges on 6 TSHTE, www.SIACUNF GIN-ERA in RGK.NEFT. Capitalization of the world in their decreasing order are the New York Stock Exchange, the Nasdaq, the Tokyo Stock Exchange, the London Stock Exchange and the Bombay Stock Exchange. 3. Trading in the stock exchanges takes place via the mediators known as the brokers, the jobbers, the market maker, discussed later in this chapter. As per the latest information presently, there are a total number of 26 stock exchanges operating in India, 7 at the national level and rest 19 at the regional level. One of it, Coimbatore Stock Exchange recently sought for withdrawal of recognition. The matter is sub judice under SEBI. A brief account of the national level stock exchanges is given below. NSE, the National Stock Exchange of India Limited, NSE, was set up in 1992 and became operationalized in 1994. The sponsors of the exchange are financial institutions, including IDBI, LIC and GIC, with IDBI as its promoter. It has a 50-share index and a 500-share index known as S&P CNX 50, Nifty 50, and S&P CNX 500, respectively. OTC, though the over-the-counter Exchange of India Ltd, OTC, was set up in 1989, it could commence trading only in 1992. India's first fully computerized stock exchange was promoted by the UTI, ICICI, SBI Cap among others, in order to overcome problems such as lack of transparency and delays in settlements prevalent in the older stock exchanges. Another important goal of the exchange was to allow stock market exposure to comparatively smaller companies. Companies with paid-up capital from 30 rupees lakh to 25 rupees crore are enlisted here. Trading in this exchange takes place via market makers and commission is fixed. ISE, the Interconnected Stock Exchange of India, ISE, is basically a single floor of India's 15 regional stock exchanges, RSEs, set up in 1998. The RSEs were provided increased reach through this. It is a web-based exchange. BSE, the Bombay Stock Exchange Limited, BSE, earlier a regional stock exchange, converted into a national one in 2002. The biggest in India, it accounts for almost 75% of total stocks traded in India and is the fifth largest in the world, on the basis of market capitalization. There are at present 4 indices connected with the BSE, I, Sensex. The sensitive index, i.e. Sensex, is a 30 stocks index of the BSE which was enlarged to include 50 stocks in 2000 but soon was cut down to the original level. This index represents the Indian stock market.
2.
BSE
BSE
200. This is a 200 stock SHVISRTE, WIV NWD.EX ASIOEF NGTIH NAERBINGS.NET, including the 30 stocks of the Sensex, which has its dollar version 2, the Dolex. 3. BSE 500. In mid-1999, the BSE came up with a 500 stock index representing major industries and many subsectors of the economy, with information technology getting a significant weightage. 4. National Index, an index of 100 stocks being quoted nationwide, Bombay, Delhi, Kolkata, etc., was developed to give wider representation of the stock market, since the Sensex consists of only 30 stocks. The 30 stocks of the Sensex are included in the National Index. This index is computed by the Statistics Department of the BSE, hence it is called the BSE National Index, BSNI. Indonext, a new stock exchange to promote liquidity to the stocks of the small enterprises, SMEs, was launched in 2005 jointly and medium the BSE and the FISE, Federation of Indian Stock Exchanges, representing 18 regional stock exchanges. Times it is better known as the BSE Indonext. It was also an effort to rejuvenate the RSEs, which were facing falling volumes of trading on their floors. Due to absence of trading at the RSEs, the stocks of the SME has become illiquid. The BSE will transfer all its B1 and B2 groups to this exchange. The RSEs also transfer their enlisted companies to the new exchange. Now the RSEs will be able to use the BSE network online, the WebEx. SME exchanges, BSE SME and Emerge 5 SME Exchange is a stock exchange dedicated for trading the shares of small and medium-scale enterprises, SMEs, who, otherwise, find it difficult to get listed in the main exchanges. The concept originated from the difficulties faced by SMEs in gaining visibility or attracting sufficient trading volumes when listed along with other stocks in the main exchanges. To be listed on the SME exchange, the post-issue paid-up capital of the company should not exceed 25 rupees crores. This means that the SME exchange is not limited to the small and medium-scale enterprises, which are defined under the Micro, Small and Medium Enterprises Development Act, 2006, as enterprises where the investment in plant and machinery does not exceed 10 rupees crore. As of now, to get listed in the main boards like National Stock Exchange, the minimum paid-up capital required is 10 rupees CR and that of the BSE is 3 rupees CR. Hence, those companies with paid-up capital between 10 rupees CR to 25 rupees CR have the option of migrating to the main board or to the SME exchange. The companies listed on the SME exchange are allowed to migrate to the main board as and when they meet the listing requirements of the main board. There shall be compulsory migration of the SMEs from the SME exchange, in case the post-issue paid-up capital is likely to go beyond the 25 rupees crore limit. World over, trading platforms exchanges for the shares of SMEs are known by different names such as alternate investment markets or growth enterprises market, SME board etc. Some of the known markets for SMEs are AIM, alternate VI in STB, EWSWTWM.EE and SYTEM and GIANA Acrea NGT, .NAT in UK, TSX Ventures in Canada, GEM, Growth Enterprises Market, in Hong Kong, Mothers, Market of the High Growth and Emerging Stocks, in Japan, Catalyst in Singapore and Chinext, the latest initiative in China, see, World Federation of Exchanges for latest comparative idea. Globally, most of these SME exchanges are still at an evolving stage considering the many hurdles they face times declining prices of listed stocks and their illiquidity, times a gradual reduction in new listings and decline in profits of the exchanges etc. For instance, IM had 3 predecessors, Catalyst succeeded SESDEC with new regulations and listing requirements. Times in most jurisdictions, idea of a separate exchange for SMEs have become unviable and hence tend to be platforms of existing exchanges, perhaps cross-subsidized by the main board exchange. In India, similarly, after the 2 previous attempts OTC, Over-the-Counter Exchange of India, 1989, and Indonesia, the market regulator, SEBI, on 18 May 2010 permitted setting up of a dedicated stock exchange or a trading platform for SMEs. The existing BSE's stock exchanges in India, BSE and NSE went live on 13 March 2012 with a separate trading platform for small and medium enterprises, SMEs. BSE has named its SME platform as BSE SME while NSE has named it as Emerge. Unlike in India, many of these SME exchanges in various countries operate at a global level, due to smallness of the market, allowing for listing by both domestic as well as foreign companies. Though the names suggest that they are set up for SMEs, these exchanges hardly follow the definition of SMEs in their respective jurisdictions. Also, many of them follow a sponsor-supervised market model, where sponsors or nominated advisors decide if the listing applicant is suitable to be listed or not, i.e., generally no quantitative entry criteria like track record on profitability or minimum paid-up capital or net worth etc. are specified to be listed in these exchanges. Instead, they are designed as buyers beware markets for informed investors. SEBI has also designed the SME exchanges in a similar format with provisions for market making for the specified securities listed on the SME exchange. As is the case globally, certain relaxations are also provided to the issuers whose securities are listed on the SME exchange in comparison to the listing requirements in main board, such as in BSE and NSE, in the case of India, which include I. Publication of financial results on half-yearly basis, instead of quarterly basis, making it available on their websites rather than publishing it. 2. Option of sending a statement containing the salient features of all the documents instead of sending a full annual report. 3. No continuous requirement of minimum number of shareholders, though at the time of IPO there needs to be a minimum of 50 investors etc. 4. The existing eligibility norms like track record on profits, net worth, net tangible assets conditions etc. have been fully relaxed for SMEs as is the case globally. However, no compromise has been made to corporate governance norms. Common facts about the
HB and ESAT, LWSWTWO.EC asked why any gigs net up INGA.NNHs before the arrival of national level stock exchanges. India was not having any exchange of national status. Better say there was no Indian stock market but stock markets showing only regional pictures. Besides, the national stock exchanges did solve some major problems of stock market. We may also call their arrivals as part of the stock market reforms in India. The common features of these exchanges are: A. All are situated in Mumbai. B. All do screen-based trading. SBT. C. All have their trading terminals in the major cities of the country. D. All are web-enabled. E. All are limited liability companies. F. The brokers registered here have no say in either the ownership or the management of the exchanges. G. All are counted among the best and the most technology-equipped stock exchanges in the world. 6 players in the stock exchanges. Broker. Broker is a registered member of a stock exchange who buys or sells shares securities on his client's behalf and charges a commission on the gross value of the deal. Such brokers are also known as commission brokers. Brokers who offer services such as investment advice, client's portfolio planning, credit when a client is buying on margin other than their traditional commission job are known as full-service brokers. In India such brokers are just coming up. Jobber. A jobber is a broker's broker or one who specializes in specific securities catering to the need of other brokers. In India also known as Thavanivale in the BSE. 7. A jobber is located at a particular trading post on the floor of the stock exchange and does buying and selling for small price differences, called the spread. He has no contact with the investing public. In the London Stock Exchange, he is called a market maker, while in the New York Stock Exchange, he is called a specialist. The Bombay Stock Exchange has made it mandatory for every company with a share capital of over 3 rupees crore to appoint jobbers or market makers if it seeks enlistment. Such an arrangement enables investors to buy and sell shares on the stock exchange and thus liquidity increases. Market maker functions as an intermediary in the market ready to buy and sell SEBI UIRCITT, if AUSW. HERSYESN Ingenu LXRIA NNG.E auto sleep quotes. SEBI two-way rates. Like a jobber basically whisper T. If FWWT.HE ASIO and NG lie need re NFGF.E are tensed that he quotes two-way rates for buying and selling at the same time. 8 on the floor of India's OTC, over-the-counter stock exchange of India Limited. Only market makers are allowed to play. In the money market of India, the Discount and Finance House of India, DEFI, is the chief market maker 9. Since he quotes a selling price while buying a particular share, he makes market for that share, hence such a name. The Nasdaq of the USA is a market maker's stock exchange where they are connected by the web-enabled trading terminals. The regulator of Indian stock market, set up under the Security and Exchange Board of India Act 1992, as a non-statutory body set on 12 April 1988 through a government resolution in an effort to give the Indian stock market an organized structure, with its head office in Mumbai. Its initial paid-up capital was 50 rupees crore provided by the promoters, the IDBI, the IFCI and the ICICI. The board of SEBI comprises 9 members excluding the chairman, 1 member each from the Ministries of Finance and Law, 1 member from the RBI and 2 other members appointed by the central government. It has 4 full-time members, including the chairman. Main functions powers of the board as per the SEBI Act 1992 are I. Registering and stock exchanges, merchant banks, mutual funds, underwriters, registrars to the issues, brokers, sub-brokers, transfer agents and others. 2. Levying various fees and other charges, as 1% of the issue amount of every company issuing shares are kept by it as a caution money in the concerned stock exchange where the company is enlisted. 3. Promoting investor education. 4. Inspection and audit of stock exchanges and various intermediaries. We performing other concerned functions as may be prescribed from time to time. Commodity trading happens similar to stocks, shares, securities, debentures, bonds, trading in the stock market. However, commodities are actual physical goods such as corn, silver, gold, crude oil, etc. Futures are contracts for commodities that are traded at a futures exchange like the Chicago Board of Trade, BOT. Futures contracts have expanded beyond just commodities. Now there are futures contracts on financial markets like foreign currencies, interest rates, etc. Commodity futures serve a great purpose in any economy. As we see in the case of agricultural commodity, their prices play a key role in determining the fortune of the agriculture and food processing industry in India. These prices undergo a large degree of fluctuation. Reasons for price fluctuation are crop failure, bad weather, demand-supply imbalance, etc. This fluctuation, in turn, leads to a price risk.
This price risk weakesty, SWW.EGASYLAYNGB the farmer and the industries where agricultural commodities are used as raw material. Commodity exchanges are associations that determine and enforce rule and set procedures for trading of commodities. The main objective of the exchange is to protect the participants from adverse movement in prices by facilitating futures trading in commodities. If the participants hedge themselves against this price risk, then they would be able to insulate themselves against the inherent price fluctuations associated with agricultural commodities. One of the methods of doing this would be by using commodity exchanges as a trading platform. Apart from hedging against price risk, a commodity exchange helps in production and procurement planning as one can buy in small lots. Further, as the exchange consists of various informed industry participants, price discovery is more efficient and discounts the local and global factors. Let us take a very simple example to understand how trading on commodity exchanges help industry participants. A farmer who is producing wheat can sell wheat futures on a commodity exchange. This will help him lock in a sale price of a specified quantity of wheat at a future date. Hence, the farmer would now be able to get an assured price for his produce in future, and any decline in the price of wheat would not impact his earnings. On the other hand, a user industry, e.g. a flour mill, could purchase the wheat futures from the exchange. Hence, the flour mill would now be able to fix its future purchase cost for a specified quantity of wheat. Therefore, any increase in the price of wheat in future would not impact its cost of production. However, what needs to be kept in mind is that farmers do not largely operate in the futures market. This is partly due to operational difficulties and lack of knowledge. Though, they observe the price trends emerging from a futures market and then decide what commodity in what proportion to cultivate. In case of user industries, commodity exchanges help them to plan their production and determine their cost of production. Commodity exchanges are an effective tool to hedge price risk. However, the government needs to improve infrastructure, put in place vigilant governing systems, etc. to encourage trading on these exchanges. Big money started flowing into commodity futures with the advent of online multi-commodity exchange. The boom, which began when the stock market was sluggish, has surprisingly not waned even after the Sensex crossed 20,000 by June 2004. High stakes, long trading hours and comparatively little knowledge about the derivative products have underscored the role of a regulator. The Forward Markets Commission, FMC, which for decades was entrusted with the job to curb forward trades, now has the job to develop and regulate the commodity futures market. FMC, the Forward Markets Commission, FMC, is a statutory body set up under the Forward Contracts Regulation Act 1952. It functions under the administrative control of the Department of Consumer Affairs, Ministry of Consumer Affairs, Food and Public Distribution. Headquartered at Mumbai with one regional office at Kolkata, the Commission comprises the chairman and 2 members. The Commission provides regulatory oversight in order to ensure I. Financial integrity, i.e., to prevent systematic risk of default by one major operator or group.
Of operators,
WIST,
TR,
TR. 2. Market integrity, i.e., to ensure that futures prices are truly aligned with the prospective demand and supply conditions, and 3. Protection and promotion of the interests of consumers non-members. After assessing the market situation and taking into account the recommendations made by the Board of Directors of the Commodity Exchange, the Commission approves the rules and regulations of the commodity exchanges in accordance with which trading is to be conducted. It accords permission for commencement of trading in different contracts, monitors market conditions continuously and takes remedial measures wherever necessary by imposing various regulatory measures. At present, there are 21 commodity exchanges in India including 3 national level exchanges recognized for conducting futures forward trading. The 3 national exchanges are 1. Multi-Commodity Exchange of India Limited, MCX, Mumbai. 2. National Commodity and Derivatives Exchange Limited, NCDEX, Mumbai. 3. National Multi-Commodity Exchange of India Limited, NMCE, Ahmedabad. In US, which has the largest commodity futures market, there are separate regulators for equities and commodities. Single regulator exists in China, UK, Australia, Hong Kong and Singapore. Japan has a different model for its derivatives market, with multiple product type based regulators. Raising capital in the primary market. There are 3 ways in which a company raises capital in the primary market. Public issue. A public offer is open for all Indian citizens, the most broad-based method of raising capital and the most prestigious. 2. The Reliance Industries Limited is the biggest company of India in this category. Rights issue. Raising capital from the existing shareholders of a company. It means it is a preferential kind of issue restricted to a certain category of the public only. Private placement. Raising capital by selling shares to a select group of investors, usually financial institutions, FIs, but may be to individuals also. This is done through a process of direct negotiations, completely opposite to the public issue. The advantage of this route is the substantial saving a share issuing company makes on marketing expenses, but the risk of shifting loyalties of the investors in this route is also the highest. Recent times have seen such capital raising by many companies privately placing their shares to the foreign institutional investors, FIIs, as a route to source foreign exchange in India, and that too quickly.
Scrip share, a share given to the
existing shareholders without any charge, also known as bonus share. Quit share, a share given to the employees of the company without any charge. Roll ING settlement. An important reform measure started in the Indian stock market in mid-2001 under which all commitments of sale and purchase result into payment delivery at the end of the X days later, where X stands for 5 days. Some shares have X as 1, 2 or 3 days, 2. Today, all shares are covered under this provision. But when the buyers want postponement of the transaction in Western world called contango. Under Badla when the sellers want postponement of the transaction, also known as the reverse Badla or backwardation. Futures are trading allowed in shares where a future price is quoted for the shares and the payment and delivery takes place on the predetermined dates. Depositories started in 1996 under which stocks are converted into paperless form, dematerialization of shares shortly known as the DMAT. At present, 2 public sector depositories, Mumbai, are functioning in India set up under the Depositories Act, 1996, I, NSDL, National Securities Depositories Limited. 2. CDSL, Central Depositories Services Limited. Spread. The difference between the buying and selling prices of a share is called spread. Higher the liquidity of a share, lower its spread and vice versa. Also known as jobber's turn or margin or haircut. WIST, TR. Important terms of stock market.
Term dealings. WIST,
TR. The transactions of stocks which take place outside the stock exchanges, unofficially and take place after the normal trading hours. NSCC, the National Securities Clearing Corporation, NSCC, a public sector company set up in 1996, takes the counterparty risk of all transactions done at the NSE just as an intermediary guarantees all trades. Demutualization, a process started 2002 by SEBI, under which ownership, management and trading membership was to be segregated from each other. No broker was to be on the board of directors or an office bearer in a stock exchange. This has been done in the case of all stock exchanges except 3 regional stock exchanges, RSEs, in India. Authorized capital, the limits up to which shares can be issued by a company, also known as the nominal or registered capital. This is fixed in the Memorandum of Association, MOA, and the Article of Association, AOA, of a company as required by the Companies Act, law. Paid-up capital, the part of the authorized capital of a company that has actually been paid by shareholders. A difference may arise because all shares authorized might not be issued, or issued shares are only partly paid up. Subscribed capital, the amount actually paid by the shareholders or have been committed by them for contribution. Issued capital, the amount which is sought by a company to be raised by issuing shares which cannot exceed the authorized capital of the company. Greenshoe option, a provision under which a company issuing shares for the first time is allowed to sell some additional shares to the public, usually 15%, is also known as over-allotment provision. It gets its name from the first company, Greenshoe Company, USA, which was allowed such an option. Whist, Tr.
Penny stocks, whist.
TR, the share which remains low priced at a stock exchange for a comparatively longer period. Speculators may start holding them for hefty margins. This was seen in India in mid-2006. And since such stocks get hoarded, ultimately their market prices increase. The speculators earn profit after offloading, selling these shares at high prices, and others who purchase these shares ultimately might fetch huge losses because price rise of these stocks are unintentional or each intentional manipulation and nothing else. ESOP, the Employee Stock Ownership Plan, ESOP, enables a foreign company to offer its shares to employees overseas. It was allowed in India, February 2005, provided that the MNC has minimum 51% holding in its Indian company. Earlier, a permission from the RBI was required for such an option. SBT, screen-based trading, SBT, is trading of stock based on the electronic medium, i.e., with the help of computer monitor, internet, etc. First such trading was introduced in New York in 1972 by the bond broker Cantor Fitzgerald. India introduced it in 1989 at the OTC. Now it is carried out at all exchanges. Derivatives. Derivative is a product whose value is derived from the value of one or more basic variables, called basis, underlying asset, index, or reference rate, in a contractual manner. The underlying asset can be equity, forex, commodity, or any other asset. For example, wheat farmers may wish to sell their harvest at a future date to eliminate the risk of a change in prices by that date. Such a transaction is an example of a derivative. The price of this derivative is driven by the spot price of wheat, which is the underlying. In the Indian context, the Securities Contracts Regulation Act 1956 SC R A defines derivative to include a security derived from a debt instrument, share, loan whether secured or unsecured, risk instrument or contract for differences or any other form of security. B. A contract, which derives its value from the prices, or index of prices, of underlying securities. Derivatives are securities under the SC R A, and hence the trading of derivatives is governed by the regulatory framework under the SC R A and are allowed to be traded on the floors of the stock exchanges. Indian Depository Receipts, IDRs, as per the definition given in the Companies Issue of Indian Depository Receipts, Rules, 2004, Whist, Tr. IDR is an instrument in the form of a VDI STP, OWSWF2.ERASYERN in EEI print TGC.NRET by the Indian Depository in India against the underlying equity shares of the issuing company. In an IDR, foreign companies would issue shares to an Indian depository, say the National Security Depository Limited NSDL, which would in turn issue depository receipts to investors in India. The actual shares underlying IDRs would be held by an overseas custodian, which shall authorize the Indian depository to issue of IDRs. Just try to understand in a simple way. An IDR is a mechanism that allows investors in India to invest in listed foreign companies, including multinational companies, in Indian rupees. IDRs give the holder the opportunity to hold an interest in equity shares in an overseas company. IDRs are denominated in Indian rupees and issued by a domestic depository in India. They can be listed on any Indian stock exchange. Anybody who can invest in an IPO, initial public offer, are eligible to invest in IDRs. In other words, what ADRs, GDRs are for investors abroad with respect to Indian companies, IDRs are for Indian investors with respect to foreign companies. But one question comes in mind. How does investing in IDRs differ from investing in shares of foreign company listed on foreign exchanges? Indian individuals can invest in shares of foreign companies listed on foreign exchanges only up to $200,000, and the process is costly and cumbersome as the investor has to open a bank account and demat account outside of India and comply with Know Your Customer (KYC) norms of respective companies. It also involves foreign currency risks. IDR subscription and holding is just like any equity share trading on Indian exchanges and does not involve such hassles. StanChart is the first and the only issuer of IDRs in Indian markets, which came out with its IDR issue in May 2010, through which it had raised 2,500 rupees crore on high demand from institutional investors and was listed on the Bombay Stock Exchange and National Stock Exchange. 10 StanChart IDRs represent one underlying equity of the UK-listed bank. StanChart IDRs were due to come up for redemption on 11 June 2011. SEBI came out with the new guidelines in June 2011, which ruled that after the completion of 1 year from date of issuance of IDRs, redemption of the IDRs will be permitted only if the IDRs are infrequently traded on the stock exchange in India. SEBI rules make it clear that if the annual trading turnover in IDRs in the preceding 6 calendar months before redemption is less than 5%, then only the company could go into for redemption of IDRs. The regulator had said that the company issuing IDRs would have to test the frequency of trading the instrument on the bourses on a half-yearly basis ending June and December every year. Shares, at par, and, at premium, an ordinary share in India, in general, is said to have a par value, face value, of 10 rupees, though some shares issued earlier still carry a par value of 100 rupees. Par value implies the value at which a share is originally recorded in the balance sheet as equity capital. This is the same as ordinary share capital. SEBI guidelines for public issues by new companies established by individual promoters and entrepreneurs require all new companies to offer their shares to the public at par, i.e. at 10 rupees. However, a new company set up by existing companies, and of course existing companies themselves, with a track record of at least 5 years of consistent profitability are allowed to issue shares at a premium. WIST, TR. When a company issues shares at a premium, IIUSTM, www.isasayvnlegentioarianagi.nset the required amount of capital from the public by issuing a fewer number of shares. For example, while a new company promoted by first-time entrepreneurs intending to raise, say, Rs 1 crore, has to offer 10 lakh ordinary shares at 10 rupees each, at par, an existing company may raise the same amount by offering only 2 lakh shares at 50 rupees each, close to the market value of its shares. The latter is said to have issued its share at a subscription price of 50 rupees, 10 rupees in the case of the former company, at a premium of 40 rupees, being the excess of subscription price over par value. In such a situation in India, The company's books of accounts will show 10 rupees towards share capital account and 40 rupees towards share premium account. It means that the higher the premium, the fewer will be the number of shares the company will have to service. For this very reason, following the policy of free pricing of issues in 1993, many companies came out with issues at prices so high that in many cases they were higher than their market prices, leading to undersubscription of such issues. The companies are, however, learning fast about the pitfalls of high pricing of shares, and it is only a matter of time before the issue prices become more realistic. In India, no company is allowed to issue shares at a discount, i.e., at a price below par. Again, in India, once a company has issued the shares, it cannot easily reduce its capital base, i.e., buy back or redeem its own shares. This means that ordinary share capital is a more or less permanent source of capital, which normally a company is never under an obligation to return to the investors, because a shareholder who wishes to disinvest, i.e., get back the invested capital, can always do so by selling the shares to other buyers in the secondary market. Also, in India, a company receives no tax benefits for the dividends distributed. In other words, dividends are paid by the companies out of the earnings left after taxes, and they get taxed once again at the hands of the investors. Foreign financial investors through the Portfolio Investment Scheme, PIS, the foreign financial investors, FIIs, were allowed to invest in the Indian stock market, the FIIs having good track record register with SEBI as brokers. FIIs make investments in markets on the basis of their perceptions of expected returns from such markets. Their perceptions, among other things, are influenced by times the prevailing macroeconomic environment, times the in
India.
further reform measures recently 7 STN, IFTIV outi